Hello everyone, a very good evening. Welcome to the Intraday and Scalping Strategies Masterclass by Fluential Trading. So let me know if the audio is clear. Cool, fine. Okay, thank you. So let's get started with the session. So before proceeding into the concepts, first let me discuss what are the contents and what are the topics which we're going to cover today and in which order we are going to cover them in detail. So if you see, before discussing the strategies, so let's say in intraday we have 11 strategies and in scalping we have 2 strategies. So total will be 13 strategies. But it will not be just enough if you just say about what are the strategies, because just strategies will not help you. You need to have the other knowledge as well as to like what is the right kind of a breakout, when to take an entry, when to avoid the entry, and other price action concepts knowledge also you need to have in detail. Then only if I explain any particular strategy that you will be able to understand the logic behind that, and you will be able to know why we need to take the entry, when we need to avoid the entry, etc. So before discussing these strategies, we need to first discuss about some important concepts called how to even prepare the chart for intraday trading. From higher time frame, how we need to go to the lower time frame and multi-time frame analysis, plus what are all the key levels that we need to mark in the charts. Even if you're doing intraday trading, there are some of the levels which we need to mark in the higher time frames. That also we need to discuss. Second most important topic is, whenever we say that if there's a candle which is breaking, go ahead and then take the trade. But there could be different types of candles. There could be 10, 20, 30 different types of candles that can break that particular level. So what is the right breakout? What are the false breakouts that we can experience in the live market? Regarding that also we'll be having a detailed discussion. So we need to know about that in detail. Plus, when you take a trade, where to keep the stop loss? So stop loss management is a key factor. If you keep a wrong stop loss, even for the right strategies, then also you may end up making losses, because stop loss keeping and stop loss trailing is also a key concept. So you need to know these concepts before discussing the strategies. So once these are discussed, then we will start with the strategies. Around 11 strategies we have for intraday trading, which are 5 minutes time frame based. We'll discuss this. Along with that, we will also discuss how to ride the trending markets. So in trending markets, we can get better risk reward trades. So in case of trending markets, we have some techniques to ride the complete trend if it is trending till the end of the day, or even if it's trending for half of the day, we can get to know as to how to capture that trend on that particular day, and how to and when to avoid the trading. So there could be, as an intraday trader, so here we are discussing about intraday, cash market, equity. That can be like what are the concepts that we're discussing can be used for the intraday equity cash market, plus intraday option buying for index. So for Nifty and Bank Nifty, intraday option buying can also be useful. But there could be some of the days where when the market could be completely volatile, or the market could be completely range bound, or it is not having any clear direction, etc. In those cases, you must be also knowing when to avoid the trading, because as an option buyer, or for the intraday equity buyer or sell, in intraday you can buy or sell the stocks, but in case of option buying, if you are thinking the market will go up, you will be buying a call option. If you think the market goes down, you will be buying a put option. So for these cases, we need to have some kind of a market movement should be there. If the market is not moving anywhere, then it is not better to take up any trades on that particular day, because you might end up making stop loss hit, or even the target also might not hit, even the stop loss also might not get hit, but the trade will just keep trading at the same place. That time is also getting wasted. At the same time, you are blocking some of the money instead of focusing upon some other trade as well. So you must be knowing when to avoid particular stocks on particular days, or when to even avoid trading in Nifty or Bank Nifty. That we'll discuss. Then we'll discuss some methods of stock selection process as well. Then we'll discuss about scalping techniques. Scalping techniques are in 1 minute time frame techniques. These are highly Like you need to be very fast in executing that particular things. I'll discuss more details about the scalping techniques in that discussion. So once these are completed, almost 80 to 90% of the discussion would be completed till this point of time. Then we'll be having some small concepts, which if you're a trader in, especially in Nifty or Bank Nifty, if you're trading, then you might get some queries as to how to keep the stop loss in options and which strike price to select and what are the, do we need to even check the OI data, etc. Plus Nifty and Bank Nifty comparison. Should we check both Nifty and Bank Nifty together, or we can only rely upon Nifty directly? So some questions you might have if you're a trader in index options. We'll also discuss those few topics as well. So with that, we'll be completing the session. And after that, we'll be taking a Q&A discussion. So you can ask the questions or you can message over here. Each and every question will get answered. And this entire PDF, what we're discussing, will be shared once the session is completed. I'll be sharing this PDF on the Telegram channel, so you can download that, not a problem. So instead of noting down everything, just focus upon what is being explained so that you can note down your queries and then you can ask them at the end of the session. So let's get started with the session. The first topic is plotting important levels for the intraday trading. Now, what are the important levels that you need to have on your chart before even taking a trade or looking for trading opportunities? These are the levels that we need to have on the chart. So what are these? We'll be discussing these things one by one. So first thing is, some levels we need to mark it in the higher time frames, like we'll be starting from daily time frame, then we will be going to the 1 hour time frame. So the main support and resistance levels will be marked in daily time frame, even in the 1 hour time frame. Plus, supply and demand levels also will be marked in the daily time frame and in 1 hour time frame. Sometimes supply and demand levels might not be there. So I'll also be discussing about what's the difference between support and resistance and supply and demand levels. But these are the two things that we'll be starting with, both in daily time frame and in 1 hour time frame. Then comes to the marking of gap levels. It can be a gap up market or it can be a gap down market, etc. So depending upon gap levels means it is not that on that particular day you will be marking the gap up or a gap down. It is, let's say in the last few days, if you observe any gap up which has not been filled yet, then we'll be marking that level. In the last few days, if you observe any gap down which has not yet filled, then we'll be marking that levels. This is also gap up and gap downs will be marked only after the end of that particular session. Let's say for tomorrow, you will be marking those levels today itself by looking at the previous data. That too in daily time frame only we need to check. That also I'll discuss. Then we'll discuss about these are higher time frame levels. Then from here on, these are all 5 minutes time frame. So these 5 minutes time frame includes previous day high level plus previous day low level. That we'll discuss. Then current day high and current day low level. It is not that important every time. It is only important in some of the situations that I'll explain what are those situations. But previous day high and previous day low levels, we will mark it no matter how the market is behaving. We'll mark it on everyday basis. But current day high and low levels are not important to mark each and every day. Only in few cases it is enough to mark. Then comes to the intraday leading indicator. So these three are indicators basically. These three indicators, out of these three indicators, all these are intraday indicators only. But out of these three, these two are CPR and institutional zones. These two are leading indicators. Leading indicators means these will form at the beginning of the market only. At 9:15 only, these levels will form. And these levels will not even change for the end of the market. Till 3:30, these levels will never change. They will be the same levels only. That means it is not dependent upon the price momentum. No matter how the price is moving, these levels will not change from the beginning to the end. That means these are the leading indicators because they are not reacting based upon the price of that particular day. So these two are in leading indicators. We'll discuss about in detail as to how to use them and all. Then comes to the only lagging indicator that we use. That too not every time. In some cases, we'll be using this. This is a lagging indicator, which is a moving averages. Moving averages will help us to identify the trend of the market. It could be uptrend or a downtrend or a sideways trend or like a strong uptrend or strong downtrend. How the market is going and how strong it is will be told by these moving averages. So we'll be discussing this is a lagging indicator, which means depending upon how the price is moving, these moving averages will move accordingly. If the price is strongly going in the upward direction, then this also will show you in that direction. So we don't use this alone. We'll be using this for a secondary confirmation. That means we'll be having our price action knowledge. Along with that, we'll be using this to know in which direction the market is going. So that we can look for trades in that particular direction. So this is also one indicator, but which is a lagging indicator. We'll be discussing about all these things. So let's get started with the first one, which is the support and resistances in daily time frame and supply and demand levels as well. And before even discussing that, there are two main fundamental rules in price action that you need to remember. The first rule is whatever the levels that we are marking on the charts, that means the levels which I have showed you here, any level, everything that we are marking on the charts will either act as a support or it can either act as a resistance level. That means there should be some purpose for which we are drawing that particular level. If there is no particular purpose, then there is no need to even draw that particular level. So whatever the levels that we're drawing can either act as a support level or it can either act as a resistance level. That is the first rule. The second fundamental rule is whenever a support, if it is getting broken, then it will turn into resistance. That means, let's say there is a support level. So the price is coming and taking a support. So let's say there could be two possibilities. I mean, whenever the price again comes here, we don't know whether it will take a reversal, because let's say now price can reverse like this. That is one option. Or price can break this level and then go down. That is a second option. Or price can break this level and retest to this level and go down. That is third option. Or fourth option is price can break this level and come back like this. That is called as a fake out. This is a fake out. The fourth one is called as a fake out. So now all these options are available. Whenever the price is touching any key level of a support or resistance, then all these possibilities can be arised. Now, so out of these, if I say, if there's a proper breakout like this, then in these cases, it was acting as a support till now. Now this level will turn into resistance. That means if after the breakdown, so if the price is again trying to come back to this particular level, this level can act as a resistance zone. The same level which was acting as a support previously might act as a resistance level. Because here there was a buying pressure. Whenever the price is coming to this level, there used to be a buying pressure. But once the selling pressure is more, then what happened? All these buyers' stop losses would have got hit. Then selling pressure will get created over here exactly at this level, because this is where the breakout happened. So from here on, now what happens? Everybody is a seller at this level. So whenever the price is trying to come up to this level, there could be again a selling pressure could be there. So that is the basic logic behind support becoming a resistance after a breakout. Plus, if the resistance also can become a support. So let's say now this is a resistance level. From here, if the price is going up till here, let's say the price got resistance one time and again it got resistance. But now when it is breaking on the third time, we cannot 100% say that it will get reversed, because it can give a breakout like this or it can also get reversed like this. So two things are possible now. Or even it can give a breakout and do a comeback. It's called as a false breakout. So anything is possible. We cannot, before even breaking itself, we should not assume that it will do a breakout or it will do a reversal or it will do a fake out and all. We should not assume that. We can have some perception towards what is going to happen, but we should not take any particular trades just based upon that assumption. We need to wait and watch what is happening. Based upon that only, we need to take our decisions. Now, in this case, let's say there is a proper breakout that has happened. In that case, this resistance can turn into support. That means whenever the price is coming back to this level again, this level can act as a minor support level is the basic assumption that we have to take when we're doing the price action trading. So these are the two main things that we discuss. And as I said, whatever the levels that we're marking on charts will be support and resistance, which means even if you see, previous day high or low, current day high or low, CPR or institutional zones, or even for that matter, EMA and SMA, gap levels, everything will be either a support or resistance levels only. Now let's get started with the first one, which is the important levels in daily time frame. So what we discussed, one is you can mark either support resistances and supply and demand levels. Now, for example, let's say if you see this particular example, this is Nifty chart, and if you see, this is a daily time frame level. So first we need to, whenever you are starting to take up any particular intraday trade, you need to start with the daily time frame. That means not on the day of trading, because let's say today you're trading means you need not, now itself you need not go immediately and then go to daily time frame and then 1 hour time frame, etc. You can be a little bit prepared in advance as to, let's say if you're trading in Nifty and Bank Nifty, then you can easily mark those daily time frame levels or 1 hour time frame levels even before the market opens. And those levels might need not be marked each and every day, because let's say today you have marked this resistance level in daily time frame in Nifty. Tomorrow, for example, the market ends up somewhere over here, then there is no need for you to change these levels. You can continue the same levels for the tomorrow also. So those higher time frame levels, especially the daily time frame levels, you need not mark each and every day. Once if you mark, till the time that level is not getting broken, you need not change those particular levels. So if you see, if the price is trading somewhere over here, first you need to check on the top side, what is the key level? That means at which level we can see or we can observe a resistance that is coming. There's a selling pressure that is coming that we need to identify. And let's say in this case, we can clearly see that here there is a resistance. And here also there is a resistance, resistance and resistance. And that is very clear that this level could be a key level, because presently the price is at this level, right? If it is going to go up like this, there could be some kind of a selling pressure that can be created at this level. That too, it's a higher time frame level. Whatever the levels that we mark in the higher time frame levels are more strong as compared to the levels that we mark in the lower time frame levels. So these levels we need to mark. Now this is a resistance level because multiple times the price is taking a resistance. So that top side is over. Then come to the bottom side. On the bottom side, we'll be looking for a support level. So if you see, the price fell and took some support once, second time, third time it took support. Again, whenever it came down, again it took support. That means it looks like this level is kind of a key support level. So what we will do, we will mark that zone. Not instead of drawing a single line, you can mark a simple zone like that so that you can touch multiple points. It can be wicks or it can be body also, not a problem. If you see, here we are touching all the wicks. Here we are touching, wick is touching. Here the body is also touching. Here again the wick is touching, the wick is touching. So it depends upon the type of candles. You can touch both the wicks also, or you can touch the body plus wicks also, not a problem. So you'll be drawing a support level over here. That is in the daily time frame. Then what you'll do, you will go to, let me also show the current example in Bank Nifty. So if you see, this is a Bank Nifty chart. No, this is a daily time frame. Bank Nifty spot chart. So if you see, this is where the price is trading, right? Ignore these levels for some time. These are the 1 hour time frame levels that I will tell you later. So this is the present chart. So if this is where the price is trading, first we need to look on the top side, what is the key level of the resistance that we can have. So if you see, why we have marked this particular level is, if you see from this particular level, there has been a sell off that we can see. That means from this level, there is some kind of a resistance that we can observe. And that too, there is no other level that we can see. And here also, this level after the breakout. So if you see, there was a gap up, which means the price broke this level. And after breaking this level was acting as a support level. Support, support, support. Once the support gets broken by way of gap down, so the support level, this was a support level, but it got broke because of the gap down. From that point, this level can be treated as a resistance level, because we know that whenever any support that gets broken can be assumed as a resistance level. That too, it's not a fake out. That means it did not break like this and come back like this. It is not a fake out. It's a proper breakdown and it went down. So as of now, we can take this level as a resistance level, and till the time it is getting broken, you need not change the level. Let's say if it gets broken like this, then what we will do? We will look for the next level of a resistance. Then maybe you can use this. So you can use this in under trend line tools. You can go and click this parallel channel whenever you want to draw a trend line, or whenever you not trend line, whenever you want to draw a support and resistance level, you can use this particular parallel channel and then click where you want to draw, and you can drag till where level which you want to have. And maybe you can draw this level as the next level of a resistance. But as of now, it is not required, because as of now, it is not even breaking this particular level. But if it breaks this level and if it is trading somewhere over here, then maybe when you're doing daily time frame analysis, you can draw this particular level as a key level, because we can see that from here, there's a heavy selling that has been observed. But as of now, if you mark this level, it's not a wrong thing. But the thing is, too many levels will make us confused. The main thing is we should not have cluttered charts whenever you're trading. We need to have a clear chart so that our decision making will become easier. So this level is not important as of now. So presently it is over this level, right? Now on the bottom side. So look at the bottom side. On the top side, we have marked the resistance. On the bottom side, we can see that recently the price took one support over here, and also this also kind of a support only. Whenever you say a bottom wicks no, that indicates a support. So 2 times of a support. And previously, if you see, this level was actually acting as a resistance level. Multiple times, resistance, resistance, and resistance. So whenever this was a resistance level initially. But if you see, the price broke. That means whenever the price made a gap up, which indicates that the price broke this resistance level. And it's not a fake out. Fake out means what? It broke, but the candle came like this. That means even though the market opened above this particular level, at the end of the day, if the candle is looking like this, which means it's a fake out. But in this case, it's not a fake out. It broke out, then it took some support from here, and then it was starting to go upside, which means previously it was acting as a resistance level. After the breakout, now it was acting as a support level. So what we will do, we will draw a support level at this point. Now in daily time frame, we have marked a resistance level and we have also marked a support level. That is sufficient. We need to, even though you might say that, so let's say, what is the meaning of a supply zone? Supply zone and demand zone I was talking, right? Supply zone and demand zones are generally a major move can be observed from that particular level, like a kind of a V-shaped reversal or a V-shaped recovery. If you see, this one, whenever the price came here, a sudden reversal happened. And this, if you see, from here, a sudden fall. Again, reversal, fall. So if you see, all these points are, this is a V-shaped recovery, this is a V-shaped reversal. So this is a recovery, and again a recovery, and here a reversal. So if you see, these are generally a supply zones. On top sides, these are supply zones. On bottom side, these are demand levels. Because the move is also higher, that to a sudden reversal, a sharp reversal, we can say. So whenever the sharp reversal or recovery happens, we can observe a V-shaped reversal or a V-shaped recovery like that. So these levels, now this level also is nothing but a demand level. But it is not important for us to mark that demand level for now, because maybe we can also mark this saying that this could be a demand level. But it is illogical to mark that level, because as of now, we are doing intraday trading. We are not doing a swing trading or a positional trading. So if the price is over here, so if it comes back, if it breaks this level, and if it breaks this level, and then if it is breaking this level and then coming down, then maybe we can go ahead and then mark that level. But it is not relevant for us to trade in Monday. Let's say tomorrow, if you want to trade, this level will definitely be not relevant, because tomorrow itself, the market will not crash this much and come to 32,400. So it is not relevant. So we'll be not drawing this level. But that is the general, like support and like demand and supply zones can be marked like that. Generally, if you see, this is a supply zone because a heavy fall can be observed. And here, if you see from here, it's a demand level because a heavy recovery can be observed. But that levels are not required to be marked as of now, because the price is not near to those levels. If it is price is near to those levels, then we can mark those levels. So as of now, the support and resistance levels are looking fine for us. Then we need to go to the next higher time frame, which is, to next lower time frame. that is 1 hour time frame. So if you see in 1 hour time frame, what we need to do is we need to come little bit closer to the price. That means these 1 hour time frame levels should be inside the daily time frame levels. That means one level on the top side we need to mark, one level on the bottom side we need to mark. These levels should not cross these daily time frame levels, because daily time frame will be far away levels and 1 hour time frame will be little bit closer to the pricing range, current market price. And on the top side, what we can observe. So if we go back and then check what is the next level of a resistance, we can find out that there could be one level over here. If you see, not exact resistance, we can find out this one level, but that is almost closer to the daily time frame level. So it does not make much of a sense to mark this particular level because almost both our levels are closer. Then what other level we can see? We can see this level where there is a sudden fall in the price. So from this point, there has been a sudden fall in the price. So let's look at what is happening at that particular level. So if you see presently around that particular range, there's a kind of a breakout or retest. Something is happening, but almost the market has ended at that point of time. But what we can do is, since we did not see a clear breakout, I'll tell you what is a clear breakout in the coming slides. But actually, this is not a clear breakout. Clear breakout means the price has to break with a good momentum candle. And if it is going up, then we can say it's a clear breakout. But as of now, it is not a clear breakout. It can also happen that price can come back from this level. So what we will do is we will mark a resistance level at that particular zone where the market is currently there. So that looks like this. We can also mark this entire level also as a kind of resistance level for now. Let me mark this level. Because we can't say that there's a clear-cut breakout as of that particular day. That because you can see multiple wicks on the top side. Whenever you see a wicks on the top side, that has to be understood as a selling pressure. So you can see a wick here. A wick on the top side indicates a selling pressure. Again, a wick on top side. Again, a wick on top side. That too, after a rally, it has happened. That means there could be a possibility that from here the price can reverse. So this is in a 1 hour time frame. We'll be marking this level. On top of it, after some time, we have a daily time frame level. So no need to mark anything above this particular level. Then come to the downside. So if you see on the downside, can you observe this level where the price took a resistance, and let's say if you mark this level, the price made a breakout. That means here it was acting as a resistance level. Now after the breakout, this level was acting as a support level because you can see the wick around this level. So if you mark one level, this is how it will look like. If you mark a simple zone like this, look at this. This level was acting as a resistance level. Top wick indicates a resistance level and the bottom wick indicates a support level. So the price, once it is broken, it was acting as a support. So this level we can consider as a support level in 1 hour time frame. And we can extend this like this, not a problem. Okay, so these are the levels that are required in daily time frame and a 1 hour time frame. That is sufficient. You need not mark too many levels and make it confused. So whatever we did in daily time frame, I kept it as gray so that I can identify these as daily time frame levels. And in the 1 hour time frame, I kept it as orange to look like a resistance level. So it is kept as a green so that it can be indicated as a support level in 1 hour time frame. These levels are sufficient in higher time frame. Then we'll be going for the intraday time frame levels, which are previous day high and previous day low level is the first intraday level that we need to mark. Yeah, before that, we need to also tell about the gap levels, right? So whenever you want to mark a gap level, you need to go to the daily time frame. For example, if you go to Nifty chart. So this is a Nifty chart. Let me go to daily time frame level. So this is the daily time frame of Nifty. How to mark the gaps? Whenever you want to mark the gaps, you need to come to daily time frame and then look at the current market level and see if you can observe any gaps in the recent times. We can clearly see that there is a gap here, there is a gap here, and there is a gap here. So 3 gaps can be observed over here. Now what we will do? First we will start with this level. So from here, if you see, there's a gap which has formed, which is not filled yet. Filling means, remember that whenever we're drawing a gap level, in between that gap level, the candlestick body should not be there. If the candlestick body is there, that is no more called as a gap. So we need to mark only the gaps which are unfilled. Unfilled means the candlestick body is not there in daily time frame. So if you see, there are some portion of the wicks are there. Wicks are fine, not a problem, but the body of the candle should not be there. And it's a gap up. So from here, it is making a gap up. Gap up generally indicates a support level. That means whenever there's a gap up that has happened, we can mark like this level, and that level can act as a support level. But this is not filled yet. Then what we'll do, before even filling this level, there is a one more gap level that has formed. But focus upon closely here. What happens here is, now look at the price range. How much is the gap range from here? You can see it is 180 points of a gap range. Now think logically, 180 points of a gap level, and we are saying that whenever the gap up occurs, that level can act as a support level. But do you think that, for example, support level means what? We will not be looking for a short entry opportunity when there is a support level immediately below that level. But 180 points of a support level means, if for example, let's say within few days, the market is coming down here and it started to go down, for example, then maybe there could be a possibility that for the entire day in intraday, the market could be trading in between these levels because we have almost 180 points. So the market could be trading somewhere over here and all. So we should not think that just because the price is in the support zone, it doesn't mean that we need not look for short entry opportunities. That means even though the price can start from here, for example, and it can come down on that particular day, that means there could be a clean move of even 150 points of a down move could be there. In that cases, we can look for short entry opportunities also. But if we mark like this, what happens? We assume that this entire level will act as a support zone. So what we will do to avoid this confusion, what you need to do is, whenever the gap level points are more than 50 points, that means if the gap levels, if it is 50 points or lesser, then you can simply mark that entire zone as a support level. For example, if you see, well, how much points are the 50 points from here? If you see 50 points means till this much. That means if the gap level is 50 points or lesser, then you can mark a level like this. But if it is more than 50 points, then what you do, just go to that particular on the gap up whenever the candle has gapped up. At that particular point, just mark a support level. So this is sufficient. You need not mark from this level to this level. It is not required. It is enough if you mark at this point. Plus, you can mark some zone, some kind of a support level around this point. The wick, wherever the wick part is there, you can just mark that level. That is sufficient. That means what? If the price, let's say if the market is coming down and around at this level, we might not look for a new shorting opportunities because this level can act as a support level. At the same time, this level, if the price is trading between this level, we might not look for a shorting opportunity in intraday because this can act as a support level. But in between, if the price is trading in between these levels, then not a problem. If you're having a shorting opportunity, we can look for shorting opportunity. If you're having a long opportunity, we can look for a long opportunity. We need not basically worry about because the gap up means it could be a support, etc. We need not worry about all that because the gap up is more than 50 points. When the gap up is more than 50 points, just mark one level wherever the market is going in the upward direction in daily candles, and wherever it has started from the previous day level, you can mark one level, indicating that from that level, actually the gap up started happening. In between, you need not mark any particular levels like that. And if you see the next gap up that has happened, which is actually on last Friday. So if you see, this is also close to somewhere. Now, this is not that much big range. You can mark this like this. That means now this level can act as a support level. These all levels can act as a support level. Because whenever there is a gap up and the price could not fill the gap, then only we'll be marking this. That means this level we can mark only on the end of the Friday, because at the end of Friday only we can get to know that this candle has formed like this. For example, it can happen that the market can open on Friday like this and can completely come down, and there could be a big bearish candle also. In that case, there is no gap only because the gap up formed in the morning, but the gap has been filled by the end of the day. So we need to wait for the day end to know what is the unfilled gap. Only we need to mark that unfilled gap from the previous day level body range to the current day body range. The wicks can be there inside that particular level, but the body should not be there inside that particular level. So that is how whenever the gap up happens, you can mark a gap level which can act as a support level. And whenever the gap down happens, you can mark it as a resistance level. For example, so gap down means, yeah, you can see that here the price has closed here and next day the market has opened here. That means there is a gap down, a clear gap. So what you can do on that particular day, you start from the body of the previous day candle and mark till the end of, till the body of the next day's candle. And here, since it's a resistance, you can put it as some other color and you can drag this level. That means what? This level can be acted as a resistance level. When there's a gap down, that gap down can act as a resistance level. So till the time this level is not getting broken, so we might not look for, that means if you say if the price is coming to this level, maybe at this point, we might not look for going long immediately. Maybe here we can look for going long or here we can look for going long. But let's say in intraday, if the price is exactly trading here and if we got a long entry opportunity, we might not go long because this level can act as a resistance level. So when there is an immediate resistance level, it is not advised to look for a long entry opportunities. So we will be avoiding going long when the price is around this level because this is a resistance level like that. And it can happen that when to close this level. For example, if you extend this, you will understand. If you extend this continuously, whenever the candlestick or a gap up forms above that particular level, then we'll be closing that. That means if you see, so here what happened on this particular day, on this part, which is on, I think on Thursday, the candlestick body has started and closed above this particular level. That means we will be removing this particular level. It is no more valid because it has been broken and now a gap up has formed. So we'll be removing that previous level because that is no more valid. Now we will be marking the gap up levels. Like that, whenever there's a gap down, you can mark the gap down. And whenever there's a gap up, you can mark the gap up. Plus, if you see tomorrow, for example, let's say the market has opened here. And at the end of the day, it has created a candle like this, for example. Then what we need to assume that this level has been broken because what price came from this level to this level all the way, but by way of a gap down, which means even the gap down also, we need to assume that this level has been broken. Then we need to remove this particular level. It is no more a support level. We have to remove this particular level. And that gap down is happened, right? That gap level, we can mark it as a resistance level. So like that, we need to, till the time it is getting unfilled, we can continue that. But once it got broken, we need to remove those particular gap up and gap down levels. And these levels has to be marked only in the daily time frame levels. This is also nothing but a support and resistance. So whatever we are marking is nothing but a support or a resistance only. These are the higher time frame levels. Then coming to the lower time frame levels. The first thing is previous day high and previous day low. Now, for example, if you see this Bank Nifty chart on 13th, focus upon the 13th day. So the price has opened here and came down all the way down. And from here it took support and again it took support, 2 times it took support and closed it somewhere over here, right? Now, simply by looking at this basic price action concepts, what we can understand, there could be some selling pressure here. Because of that, the price fell so much. And even the price is falling so much, you can see continuously falling. But from at one point, it took a minor support and went up. And again, second time also the price took support at that level. So if you see, this is the highest level that is there on that particular day. And this is the lowest level that is there. So the previous day, for the next day, which is on 14th of July, for the next day, what will happen is, we need to consider this level as the previous day high and this level as the previous day low level. because previous day, which is on 13th, this is the highest point. And that level can act as a resistance level because that there is some kind of a selling pressure. And because of which that is the highest point, from there the price came down. And this is the lowest point on 13th, which means there could be some kind of a buying pressure that is there. So this can act as a minor support level. So when you're trading on 14th, these two levels are key levels. So you'll be marking previous day high level, previous day low level. Now, there could be three things that can happen. The market can open in between previous day high and previous day low level, or it can open here above the previous day high level, or it can open below the previous day low level. These are the three situations that can happen. Now, if it opens in between, then our assumption is if the price opens in between and if it reaches the previous day high level, there could be some kind of a resistance the price can face around this level, because yesterday also there could be some selling pressure. So today also, if the price is reaching the same level, there could be some resistance that can form. That is the assumption. That is why it is generally treated as a previous day high is generally a resistance level by default. Or if the price opens in between and if it goes down, then there could be a possibility that it can act as a support level. Support level means it doesn't mean that the price will take a reversal. Even if there is a small wick or small bullish candle, if it forms, that's also, it means that it's acting as a support level only. So if you see on this particular day, what happened? The price opened in between and it came and touched this level. The moment it has touched the level, we can check some bullish candle over here. Some small support has been observed. And again, it broke this level. So this bearish candle, we can clearly see that the price broke that level. And you know that this is a support level. Once the support gets broken, what will happen? This support will turn into resistance. The same level, if you can see the same green level, which was the PDL level, previous day low level, which was acting as a support. But once the support is broken, it was acting as a resistance and resistance, because that's a basic fundamental price action concept. Once the support is broken, it's acting as a resistance. Now, this is when it is opening in between the two levels. But let's say if the price opened above the previous day high, then this level will not change. The level will be the same level, because that is what is the same level for the yesterday's high. The level will be same, but here we will assume that by default, it's a resistance level. But when there's a gap up, it means that the price broke this level and made a gap up opening. So that means the resistance has been broken. When the resistance has been broken, we need to take this level as a support level. So from the beginning itself, we'll be treating this level as a support level because it was initially a resistance level, but once it got broken by way of gap up, we will assume that it has been broken out. Then for intraday, these are 5 minutes time frame only. So for intraday, we will assume this as a support level. That means if it comes down, we will assume means it could be a possibility that price can take a small support over here. And again, whenever the support gets broken, it will again act as a resistance level. But before it is getting broken, it can act as a support level is the assumption. At the same time, if the price opens below this particular level, and if it comes back to this level, initially it was a support level, but once it got broken by way of a gap down, then we need to take this level as a resistance level, which means there could be a possibility that the price can take some resistance. And if it breaks this level in intraday, then again, the resistance will turn into support. So that is the importance of previous day high and previous day levels. These are the mandatory levels. Every day we need to mark these levels. And sometimes it happens that the price will open over here and then continuously it will go up. In that case, obviously, since the price is not touching this level might not be useful for that particular day because the price is going in the upward direction. And at the same time, the price can open with a gap down and continuously go down. In that case, these two levels will become irrelevant because price is not coming anywhere closer to those levels. So there is no option for them to react. So it can happen that on that particular day, these levels also might not be useful. Only if it is touching those levels, then only it can react. If it is not touching, obviously it cannot react to the market. So that is called previous day high and previous day low level. And one more level in intraday time frame is current day high and current day low level. Current day high and low level, when we need to mark is when the market forms something like this, which means, so before 10:30 or before 11 o'clock, generally what happens is the price will open somewhere, it will create a high level, So let's say if this is the opening level. Where is the opening? This is the opening level. So let me show this opening level. So what happens once the price opens somewhere, it will go up or it will go down. In this case, it went up and price formed a range over here. This is a high and it came to the same opening level. It came back to the opening level and it came down, went down and it created a low. And what happened? Again, it came to the opening level. So what happened here is price opened here, went up, came back to the opening level, went down and again came back to the opening level. Now in this case, whenever you see these kind of two triangles, that means just for the remembering purpose I'm saying, but generally what's happening is opening, went up, came down to the opening level and again from here it went down and came back to the opening level. When this happens, then we can say that current day high and current day low level could be important, because whenever this is happening, it indicates that the market is not having any clear direction. If market is having a clear direction, then market can go up like this bullish, or if the market is bearish, it can go down like this. But now what is happening? It is going up, coming back to the same level, opening level, going down and again coming back to the same level. This indicates that the market is not having a clear-cut direction. When the market is not having a clear-cut direction, we can assume that the market could be trending till the time it is breaking the day high or a day low level clearly. So that is why we'll be marking the current day high level and current day low level. That means till the time the price is not breaking these levels properly. That means if you see the price, when it is touching this level, again it took resistance. And again, when it's trying to break, it could not be a proper breakout. It took resistance again. On the bottom side, so this level will be marking, right? So when the price is trying to touch the bottom side, it took support again. That means we cannot see a proper breakout and continuation above this current day high level. At the same time, the breakdown and continuation cannot be observed below this level. Those are the current day high and low levels. That means only in this kind of scenarios, it is important for us to mark the current day and high and low level. Otherwise, in other scenarios, it is not that important, because what happens in case of a trending market, the price might open like this and it can continue. It will break the day high and forms a new high. After some time, within 15 minutes, it can form a new high. After 30 minutes, it can form a new high. So in that cases, the high will keep changing. It is not that much important for us to keep on marking the new highs and all. It is as good as the price is in an uptrend. At the same time, if the market is going down, it can form a low. Again, it can break that particular low and form a new low. Like that, new lows will keep forming. In the day also, it is not important to mark the day high and day low. But if you see the market is not going anywhere, it's going up, coming back to the same level. In that cases, it's important to mark the current day high and low level, because those levels can act as a key level of a resistance on the top side. On the bottom side can act as a key level of a support. So that is when you need to mark these levels. And it might not be this type of candlestick formation might not happen all the time, but whenever it happens, you will mark it. Otherwise, you need not mark it. Then comes to the CPR. So if you see, we are starting with this only. What are the important levels? So support resistance, supply and demand zones, gap ups, and previous day high and low, current day high and low. So now we have CPR and institutional levels and EMS. So we'll discuss about the CPR now. So coming to the CPR. So CPR means a central pivot range. And this is also, as I said, it's a leading indicator, which will form at 9:15 automatically once you enable the indicator. And it's a leading indicator. That means it will form, and till the end of the day, these levels will not get changed. So CPR full form is central pivot range, which means it's a range and it's not just a line. It is a range. So what this range will tell us is, basically this is how the CPR will look like. The three lines you will get to see. And the middle one is a central pivot line, top one is top, and bottom one is a bottom pivot line. The CPR value will be decided upon the previous day's value. That means previous day high, previous day low, previous day close. If you divide it by 3, that means if you do an average, you will be getting the central pivot line for today. Like that, for top, bottom, and for top also, there is a formula. There is no need to remember the formula, because the indicator will automatically form the levels. You are not going to mark them manually. And then CPR acts as a dual role. That means it can either act as a support level, plus it can either also act as a resistance level. So when will it act as a support level? When will it act as a resistance level? Let's understand. That too, there are majorly three kinds of a CPR. One is wide CPR and one is virgin CPR, then one is a narrow CPR. Wide CPR means the gap between these levels will be a little bit higher. That means we can clearly see a good amount of a range between the top level and between the bottom level. That means a good range is there. What is a good range means? You can compare with the candlesticks. So the candlesticks size, when you compare with the range size, you can clearly see that this any one particular candle can easily fit inside this CPR range. That means it is wide enough that the candlesticks can fit inside that particular range. That is called as a wide CPR. By looking at normal CPRs also, we can see some will be very, very close. Some days the CPRs will be, the lines will be very, very close. In that cases, that is called as a narrow CPR. Sometimes it will be very wide. So in those cases, it is treated as a wide CPR. So these are the generally when the gap is wide, it's called as a wide CPR. And it's when it is narrow, it's called as a narrow CPR. The main difference between a wide CPR and a narrow CPR is the strength. Strength means wide CPRs can act as a good level of a support or resistance. And narrow CPRs will also act as a good level of support and resistance. But when you compare it with wide CPR, it is acting as a weak level of a support or resistance. When you compare both wide and narrow CPRs, wide CPRs will act as a good level of a support resistance as compared to the narrow CPR. Narrow CPRs are comparatively weaker than the wide CPRs. That is the two things. Now there is some concept called as the virgin CPR that I'll discuss after some time. First, let's get more details about wide CPR. So what can happen? So the market, so like this, for example, three things can happen. The price can open within the CPR, or the price can open above the CPR, or the price can open below the CPR. These are the three situations that can happen. For example, let's say the price opened below the CPR. And these levels, as I said, will not change for the entire day. It will form at 9:15 itself. So you know what are the CPR level that is going to be formed. Now in this case, the price opened below. If the price opens below and if it is going down like that, then this level will not be of any use for that particular day. But let's say the price opened below, and then if it is trying to go and reach that CPR level, then this CPR can act as a resistance level because the price is below. If it's trying to touch some level which is on the upper side, that level can act as a resistance level for that particular day. And price can take a resistance and then go down. It doesn't mean that the moment it touches the level, it has to act as a resistance. This entire zone can be a resistance zone, which means the price can go up till here and then get rejection, or it can go till here and then get rejection. Somewhere in between, it can get rejection. So at any point, this entire range will be treated as a resistance level. So it can happen that it can reject from any particular level. Sometimes if the price is bullish, let's say sometimes first time it can get rejection, second time also it can get some rejection. But finally, if the price is bullish, it can also break this level, because we know that no support will keep acting as a support for all the time. No resistance will keep acting as a resistance for all the time. Any support or any resistance level can be broken depending upon the market situations. But before it getting broken, these levels can show some kind of a support or some kind of a resistance. That is when the price opens below CPR, this can act as a resistance level. If the price opens above the wide CPR, then you can see if the price is opening, this is a very wide CPR because the gap between the levels are very big. So the price can act as a kind of a support level. That means when the price is trying to come to and touching this level, since it is coming from top side, on the bottom side, we have some CPR level. That level might act as a support level. Or it can also take support from here, or sometimes it can also take support from here. This entire range is generally considered as a support level for that particular day. And it can also happen that price will open inside the CPR. That means the price will open, the candlesticks will either open or close within the CPR range. That indicates a neutral or no trade zone. Because whenever the candlesticks are touching or either opening or closing within the CPR level, that generally indicates a no trade area because the market will not have a clear-cut direction. It can go up or it can come down. It can be volatile or it can be sideways also. So whenever the candlesticks are struck inside the wide CPR, generally we don't take up any particular trade because most of the times, unless and until the price is trying to come out and then continue in any particular direction, we don't initiate any particular trade till the time it is completely within that particular range. That is actually a no trade zone when the price is struck inside a particular wide CPR. So that is called as a when price opens inside wide CPR. That is generally treated as a no trade area. Then coming to the virgin CPR. So as I said, we have three main CPRs, right? So one is wide CPR, narrow CPR, and virgin CPR. Let's now discuss about what is a virgin CPR. So virgin CPR indicates that, for example, on any particular day, if the price is not even touching the CPR zone for the entire day, that means the price is trading somewhere over here and the CPR is somewhere over here. That means on this particular day, this is of no use. But we can extend this range for the upcoming day. We need to do this manually. This will not get formed automatically. We need to find it out and we need to extend it manually for the next coming day. Now, if you see, this level can also act as a, just like the wide CPR, this level also will act as a wide CPR only. That means a good level of a support or good level of a resistance. So if you see on the next day, whenever the price is crashing and then coming to this level act as a support level. Again, this level was acting as a support level. Somewhere over here, some small support. Again, the price was, so whenever the candles are inside the CPR zone, it's a no trade area. But it is actually not a CPR for that particular day. For that particular day, this was a CPR. But this is a virgin CPR. We can also call it as a VCPR. VCPR for this particular day, which because that we have to do it on a manual basis. We need to drag it on a manual basis. So that level also is nothing, but it will also act as a good level of a support or resistance. Now it can happen that this virgin CPR might not touch on the next day also. Next day also the price could be somewhere over here. In that case, we need to further extend this particular level. Like that, we can extend it for 4 to 5, maximum 6 days, we can extend it. 6 trading sessions, we can extend that particular level. Even after 6 trading sessions also, if the candlestick is not touching this virgin CPR level, then we need to remove this level because the strength of that virgin CPR will not be that much. And how to add the CPR means, go to your trading view. And if you go to the indicator section and search for CPR, there could be many CPRs you might get in the library. We generally use CPR by KGS, this level, CPR with pivot levels. So when you click on that, you can go for 5 minutes time frame. And this is how it will look like. Multiple levels you will be able to see. Then what you need to do, you need to go to the settings of that and go to the style section. First go to the input section. In input section, we just need the today's pivots only. So remove the tomorrow pivots, remove the weekly pivots, remove everything. Just enable the first one and the last one. So if you go and then next go to the style section. First thing is you need to disable everything except from the first one and last one in the input section. Then go to the style section. Then disable R1, R2, R3, R4, S1, S2, S3, S4. Disable these things. That's it. You can click on OK. So this is how, now you can see the blue lines, right? These blue lines are the CPR. So if you see, this is a white CPR. Now this white CPR could not be touched by the price. Then what you need to do, you can extend this white CPR for the next day. That will be called as a virgin CPR. For this also, you can use this parallel channel option and start from this level. So you can mark any color. Let's keep it blue. And for the coming day, which is on tomorrow, this level is a virgin CPR. For example, let's say tomorrow also the market stayed somewhere over here. Then what you will be doing, you will be extending this level for the one more day. Like that, till the time the price is touching this level, we will extend it. If the price touches that particular level, if the price touches and takes some support, etc., then for the next day, we did not extend this level. We will close it off on that particular day only. But if the price is not touching, then we can extend it for almost 5 to 6 trading sessions we can extend. And after trading sessions means like working days, we'll extend. And if it is still not touching, then we'll remove this level like this. We'll just keep it and we'll remove this, delete it. So that is the Virgin CPR concept. Now you can see this. So if you see this is a white CPR again. So you can see that whenever the price is taking a support and then it was going up. So what happens is how it can help you is, for example, let's say if you're not having this particular level and you might think that, so the price is going up like this, right? So basic price action concept, how the people will use, they may draw some trend line like this. And the moment they see that the price broke and make a pullback and continuation, there could be very high possibility that even if you see the swing low level also is getting broken. So there could be very high possibility that if you just follow the basic price action principles, it is a very good shorting opportunity because the price broke this level and it also broke the swing low. So many people might go short here thinking that the price can go down, but there could be a possibility that because of this CPR level, the price took support from that level and then it went up. So if you have went short here, there could be possibility that your stop loss might have got hit. That is because not just the basic price action will work, but definitely you need to know the key levels as well. What is the key level that is near to that? Because that is where the buying and selling will happen. So you must be aware of those key levels. Otherwise, you might end up taking the wrong trades, which might hit your stop loss as well. So it is not that you should not be taking a short trade here because as per price action, you may take it. But the thing is, it's a low probability trade setup because why it is a low probability trade means immediately below that level, there is some kind of a support. Support means what? A wide CPR support can be given. So that too, we can also say that. So this level was it made a pullback. That means some kind of a resistance is there. Once the resistance is got broken, what can happen? This same level can act as a support level. So even if you take just based upon the price action also, you should not be going short here because just below this level, there is a support level. It could be possible because anything could be possible in trading. After you taking, the price can go down like this and then give you a good profit, or the price can reverse. But before taking up the trade, we don't know what is going to happen. So we will always focus upon taking the high probability trade setups, which means when we're taking a short trade, we don't want any immediate support below this level because if there is a support level, the price can reverse. In this case, wide CPR is a support level. So we don't want to take a short trade here. Like that, these CPRs will help you to find out the immediate support and resistance levels in intraday. Okay, so now that is a virgin CPR concept. Now let me ask you a question. For example, let's say on this particular day, the price only the wick has touched, but the body did not touch, but the wick has touched the CPR on this particular day. So can we extend this as a virgin CPR for the coming day or not? Yeah, so the answer is we can extend this as a virgin CPR for the coming day because the only requirement is the body of the CPR should not be closing in that CPR range. The body of the candle should not close inside that CPR range for a particular day. But if there's only wick it is touching, then not a problem. We can extend this for the upcoming trading sessions. So that is one thing. Next, we'll see what is a narrow CPR. Narrow CPR means, as we said, the range between all these lines will be very narrow. That narrow CPR also will work just like the wide CPR. That means it will also act as a support and resistance. But as I said, it is a weak support or weak resistance. So if you see here, the price started coming down. So it was acted as a support, but a weak support because it got broken easily. In rare cases, this work as a very good level of a support and resistance, but most of the times the narrow CPRs are a weak level of a support and weak level of a resistance. And that is why if you already know the CPR concept, you must have already heard that whenever the market shows a narrow CPR, it is an indication of a trending market. But that assumption is wrong assumption. Understand that just because the market opened with a narrow CPR or a wide CPR doesn't mean that the market is going to be trending or market is going to be range bound. Whether the market is in a trending or a range bound will actually be decided by the buyers and sellers of that particular day, the sentiment of that particular day and all that. But what is the assumption behind that is, if let's say on this particular day, if there's a narrow CPR and if the price is bearish on that particular day, then what will happen? Here the support is weak. When the support is weak, it can break easily. When it breaks, no, what will happen? When the support is broken, many people will come and even take the market down further, which can result in a trending market. So that is the logic behind understanding when there is a narrow CPR, there could be a possibility of a trending market because the support can be broken easily. But it doesn't mean that just because the market at 9:15, if you see just because the market with open with a narrow CPR, it doesn't mean that 100% that particular day there could be a trending market. Trending or not will be decided based upon the sentiment on that particular day and the strength of bulls and bears, strength of buyers and sellers. But the assumption is, let's say again, instead of a narrow CPR, for example, let's say there is a wide CPR on that particular day, then what could probably happen when the price is coming here? There could be some support, it can come. Again, there's some support, it can come. Some support, it can come. Which means it is not a clear-cut trending market. It could be kind of slightly downward to sideways market could be observed. So that is the logical reason between the difference between the narrow and wide CPR. So narrow CPRs might also act as a support level, but not that much strong. It can be broken easily. Let it be if it's coming from top side or even if it's coming from the bottom side, that levels can be broken easily. And in some cases, it can also act as a very good level. That means, let's say if it is coming from the top bottom side and then touching this, we can expect a reversal also, but that is some rare cases it can happen. So that is with the narrow CPR. Now we have left with one thing which is called an institutional zones. Yeah, CPR settings, you can note it down. It's just the name I mentioned here. So you can go to the PPT. Anyway, PPT, I'll be sharing it, right? So here, if you see, so it says CPR by KGS that you can check it out here. You can note down this name. So go to indicator section and go for CPR by KGS. So you'll be getting CPR with pivot levels. So click on that. Once you click on that, go to the settings of that. So you can note down these settings. Under the input section, remove everything else apart from the first one and the last one. And go to the style section and remove R1, R2, R3, R4, S1, S2, S3, S4. That is sufficient. Then you will be left with the blue lines and one red line and one green line. Tell me what are those red lines and green lines? So tell me what is this red line and green line? Yeah, so this is a previous day high and previous day low levels. This also you need not mark manually. This will get formed automatically only. So that is why with this indicator, you will get both like previous day high and low level plus CPR in just one indicator. So if you see yesterday on this particular day, if you see the yesterday level, this is the highest level. And there could be some selling pressure over here because that is where the price went down. On the top bottom side, you can see this is the lowest level. So this is the ending. So the price ended at this level. So tomorrow what happened? The next day on 21st, this PDL, which was acting, starting itself, it was acting as a resistance support level because it's generally will act as a support level, and price opened in between only, in between PDH and PDL, it has opened. And when it is reaching the PDH level, you can see that it was acting as a resistance level. So that is the importance. If you don't have this level, for example, when you're not marking this level, then if you're just going based upon some basic price action concepts, it could be possible that people, what they'll see some videos and they'll think that, okay, there's a going up, making a higher high and higher low. And when it's making a higher high, so I'll be going long here because the price that too, they might give hundreds of reasons thinking that it's a double bottom pattern and there's a breakout and we can go long here, etc. and all. But there is very simple concept that yesterday the price has some selling pressure over here. So if the price is again coming back to this level, we should avoid going long immediately around this particular level. If there's a breakout and continuation, maybe we can go long, but we should be avoiding here. That's a very basic price action concept. But half knowledge is dangerous. If you're not marking the key levels, then it could happen that with the existing knowledge that somebody might have, they might take up long or short and thinks that even though they're following the right approach, they're not getting the desired results, etc. Because it will be very tempting to attempt whatever you know the half knowledge in the markets, because if you see, there could be actually 4 or 5 reasons for you to go long here. For example, let's say somebody might draw a triangle pattern, or somebody might draw, like this pattern they might draw, thinking that, okay, there is a triangle pattern breakout and I'll be going long here. Or somebody might think this as a bullish flag, bull flag, like that. When the market is going up, it made a bull flag. So after the breakout around this candle, they might think to go long. So it can happen that for us to, for any trader, when they are analyzing, they have a multiple knowledge. They will be have different traders will have different knowledge, and based upon that, they'll try to take up the trade and thinks that they are following the price action. But along with the price action, you must know this is also nothing but a price action. Marking previous day high and low level is nothing but a price action, right? Because this is the selling pressure. So tomorrow also there could be possible that when the price is reaching here, there could be some kind of a selling pressure. So just following the patterns might not work all the time. You must be knowing about key levels and when to apply or when to take the trade, when should you avoid the trade. That also you must know. So that is how why we are marking the key levels in intraday time frame. So these are one levels. Now if you go to the CPR, this one we discussed. Yeah, here also we can see some are asking for more examples, right? So you can check the price open on the top side of the CPR. And when it is coming down, first time it gave a support here, second time it gave a support. Here also, only if it breaks and then retests and continues, then we can say that the CPR level is broken. But just because one candle coming out of the CPR doesn't mean that it's a breakout. That we'll discuss again when I'm discussing about the breakout and fake out concepts. So this is not called as a breakout. We cannot say that we can go short here because we need to have a breakout, pullback, and continuation should be there. Then only we can say that the price is going in the downward direction by breaking the CPR support. But here it is again coming back. Again it took support. Again it took support multiple times. This CPR level was acting as a support level. For example, let's say if you're not having the CPR, then it could be very much possible that any beginner trader might go short around this candle or around this candle or even at this candle. There could be possibility that people can go short around these places, resulting in a stop loss hit. Whenever the stop loss hits are getting happened, they lose the confidence because they'll think that everything is they're following correctly because they'll see that there's a like lower low, lower high, lower low. They broke the swing low with a good momentum candle. So they can think that they can go short there and they'll be buying a put option and immediately the price might reverse. They might think that they are following everything correctly and even the results are not coming out. That's how they'll lose the confidence. At the same time, they'll be also losing the capital depending upon how much they are taking the risk per trade. If they are risking more than 5% per trade, they might lose within 2 trades. They might lose 10% of their capital, which will again take you to a fear or frustration mode. And then you might try to take a revenge trades. And all these things will happen and you'll even lose more money. So that's what happened when you don't know the key levels that you're getting. So this is how the levels can work out. Just a minute. Somebody is asking if they get the recording. Yes, the recordings will be provided within 1 day or 2 days. You will get the recordings. How to access the recordings will be mentioned on the Telegram. So even if you're exiting in between, not a problem. You will be getting the recordings. This is the latest data only, which is on 15th of July. So after that, if you go on this particular day, the CPR did not touch, so we'll not be using the CPR. This will be treated as a virgin CPR but if you see the price is continuously going up, and on this particular day, we already discussed the CPR. On this day, the CPR did not touch, so this will be also a virgin CPR, but the price is nowhere close to virgin CPR also, even if you extend. On this particular day also, the price could not touch the CPR zone. On the day of 21st of July, what happened here? So the first one, the price opened below. And when the price opened below and then going upside, the CPR was acting as a resistance level. The first one, you can see the candle. But as I said, the price can break that level. It doesn't mean that always it is acting as a resistance. It might act as resistance, but it got broken. And now once the resistance is getting broken, now this level will be treated as a support level. Now if you see, the price was continuously coming down, right? At this candle, we will not be going short. Because whenever any price is breaking the CPR level, it should follow up. The follow-up move should be there. So if you see, there's a breakout and follow-up move can be observed. Here there's a breakdown. Just because the candle came below the CPR doesn't mean that it broke that level properly. We need to wait for either retest or a pullback, and continuation should be there. Further continuation, if it is coming down, then we can say that the price broke that level. But here it's a fake out and price reversed. So these levels are the recent example of 21st of July. So if you're getting dots in CPR, it's just a setting. So here what you'll do is go here in the style section, and instead of these circles, you need to select the line, that's it. So if you select the circles now, you will be seeing something like this. That is just a presentation. I mean, you can change the color, you can change the thickness, anything you can change. That's up to your preference. You can put the dots also like this, or you can put the lines also. That's up to you. Okay, so let's continue further. Now, one more concept is left out, which is institutional zones, right? So we have two more concepts, which is institutional zones and moving averages. After these concepts, we'll discuss about the strategies. So now institutional zones, what are the institutional zones? If you're following us from some time, you must be knowing about the concept of institutional zones. But if you don't know, so let me explain that clearly. So first of all, what is institutional zones? Institutional zones are intraday supply and demand levels that will be valid only for the intraday, and that too only you need to check for the 5 minutes time frame only. And somebody is asking if they can use this for scalping purpose, but we need to only use these strategies in 5 minutes time frame only. These are not for scalping purposes. For scalping, we have two more different strategies that we'll discuss later. Yeah. So coming to the institutional zones, it will look like this. Like this, it will look. Two levels will be there every day. One is on the top side, one is on the bottom side of the opening level. That means the main difference between this and CPR is, first let me show you how this indicator will be added. So for this to show in your charts, we need to give you the invite only access. So for that, what we'll be doing today will be, after the class, we'll be sharing a Google form will be shared. So you need to fill your name and registered email ID that you registered for the session. And you need to fill in the TradingView profile ID. So how to get the TradingView ID? That you will get it here. Go to the top left corner, you'll be seeing your name or logo something. So click that, you'll be getting your name or logo something, you'll get it here. So here, go on profile section. So when you click on profile section, the profile section will get opened up. So you just have to copy this copy and then paste it in the Google form. So then we'll be giving you the access within 1 day. Maybe by tomorrow end, you will be getting the access. So if you fill in completely today, by tomorrow end, we'll be giving the access. Only once we give you the access, then I'll let you know on the Telegram. Once I let you know on the Telegram, then go to the indicator section, and then you will be seeing invite only scripts. When I give you the access, click on this. Then you will be seeing something called as the institutional zones. So click on that. Once you click on that, so it will open up like this. Then go to the settings. You might not see anything on the chart sometimes. Then go to the setting of that zones. Then go to, this is how it will be. Like a style section will be there. Under the style section, you can enable any of one of this particular thing. Let's say if I enable this particular thing, then go to click on that particular color and change the opacity to 0. And these two levels are important for us. One is the plot background. So the first plot background is a support level. So you can give any color which you want. We generally use the gray color. And this is first thing is the resistance level. So resistance level, in this case, what happened? Let me shade just a minute. Okay, the first level is a support level. So I gave you the blue, and the second level is a resistance level. So we gave you the gray color. You can give any color what you want, not a problem. So these two are the important levels. And sometimes what happens, if you did not enable any of these levels, nothing will be visible. So for that, you need to enable any one of these particular ADR, high or low, anything. And then you can make the opacity as 0, because that will, if you enable that opacity, you will see some other lines. So we don't want that particular lines. We can disable that. Don't disable this ADR, just reduce the opacity to 0. And then you can change the colors over here and then click OK. So this is how the institutional zones will be visible. And the best part of this particular institutional zones is no matter how much is the gap up or a gap down, always if this is the opening level, then above the opening level, one zone will be there. Below the opening level, one zone will be there. But it is not the case with CPR, because if you see the CPR, if you see, just let me remove the previous day high and low also. If you just see the CPR, when there's a huge gap up or a gap down, the levels will be somewhere and the price will be somewhere. Let's say there's a huge gap up. The levels is somewhere, the price is somewhere. That means on that particular day, these levels will not at all be useful for that particular day. On this particular day also, when there's a huge gap up, the price is somewhere and the levels are somewhere. So it is also not useful. And when there's a huge gap down also, that can happen. So there's a gap down, the CPR is somewhere and the price is somewhere. So there could be a possibility that most of the CPRs might not even touch the price for that particular day. That is because there could be a gap up and gap downs that can happen. But it is not the case with institutional zones. No matter wherever the price is opening, you can check out any particular day. No matter how much is the gap up or a gap down, always above that particular level, one level will be there. Below that particular level, one level will be there. So it doesn't matter how much is the gap up and gap down. And these levels, what are the characteristics of these levels is, it can act as a trend changer. That means, so these two levels, right? So if the price will always open in between these levels only, that is because it is coded in such a way that it will also take into account the opening level. So it knows the opening level as well. And based upon that, that levels will form and that levels also will not change for the entire day. So whenever the price is in between this, if it goes up, so three things can happen basically. One thing is it can reverse sharply. That's called as a trend changer. It was an uptrend, it can change the trend and it can come in a downtrend. Second thing is it can break it and then it can continue further. It's a trend continuation pattern. So it's a reversal pattern and or it can give a breakout and continue. That's a trend continuation. That's the second option that can happen. The third thing that can happen is the price can break and reverses. So this is a fake out. So we can also, will be also using this fake out technique to take the trades, reversal trades. So here in case of a fake out, we can look for a reversal trading opportunity that also can happen. So these are the three things that can happen. And same like this, it's on the top side, right? On the bottom side also, when the price comes, it can take a support, good support, and then reverse sharply, or it can give a breakdown and continue sharply, or it can break down and reverses. Now this is a fake out. And here we can look for a reversal trading opportunity. That is, we can look for a long entry opportunity that I'll discuss when I discuss about these strategies. I'll discuss, we have two strategies based upon the institutional zones that we will discuss over there. But this is how it will be there. So it can act as a reversal and reversal like that, or it can all break out and then continue further. Sometimes it can happen that price will not touch the institutional resistance level or institutional support zone, because the price could be a range bound market or price could be a volatile market on that particular day. Price is not going anywhere closer to any of those zones. Generally, it can happen in case of a complete range bound or complete sideways market. Those are the dead markets where you don't actually, as an option buyer, you might not find any good trading opportunities on those particular days. So it is one of the indication. In those cases, price will not go anywhere closer to either of the levels. And as I said, there's a fake out that can happen that I'll discuss when I discuss about this strategy, which is strategy number 10. I'll discuss that. That's where the fake out can happen. And somebody is asking how to get the zone. So as I said, once you fill the form and once I give you the access, I'll let you know. So once I let you know, you need to go to, to fill the profile ID, go to this top left corner, click on this particular logo or something, then you will get your profile name. To copy that profile name, go to the profile section. And here you can copy this and then paste it on the Google form, which we are sharing on the Telegram. Then only once we give you the access, then you can go to the indicator section. Then go to the indicator section. Then you will be seeing invite only scripts. Click on that. You'll be seeing only one thing, which is institutional zones. The lock will be there, not a problem. So just click on this name. Then you will be getting, sometimes you might not get anything. So when you don't get anything, don't get panicked. So go to that. So let's say if you're not getting anything, then go to the settings. As I said, you can enable any one and then reduce the opacity to 0. That's it. You can change the colors, wherever the colors you want, you can put it and click OK. So you'll be getting some levels like this. So these are the institutional levels, and how to use this, what are the strategies based upon these levels, we'll explain a little bit later. Yep. So if you see, whatever the topics which we discussed is, we discussed about the important levels that we're discussing now, right? So now let's come back. So these are the levels that we're discussing, and EMA and SMA hacks. So what is the EMA and SMA? Let's come back to the EMA and SMA. So this is the last level that we will be marking on the charts. That to these levels, EMA and SMA levels, we need not mark on all the days. It is just on the trending days these are required. In non-trending days, these levels are not required at all. So what are the EMAs and SMAs that we'll be marking on our charts? One thing is 8 EMA. EMA means exponential moving average. 20 is also exponential moving average. 50 SMA. SMA means simple moving average. So here 8, 20 and 50. These are the three moving averages. 8 will generally use it as a blue color, and this 20 will be a green color, and this 50 will be red color. So this is how we generally use. You can put whatever the colors you want. What are the advantages to enable these moving averages is, these levels also will act as a dynamic support and resistance. Dynamic support and resistance means, dynamic means it will keep changing according to the price level. But if you see institutional zones or CPR, they are not dynamic levels because they don't change according to the price levels. They'll keep at the same place. But these levels will keep changing. So if the price is going up, these lines will go up. If the price is coming down, these lines will come down. So how it will be useful is, when you want to ride a trending market, for example, let's say you have got long here due to any particular strategy. And when you went long here, and whenever the price is making a pullback, the first level of a support can be observed at a 8 moving average, 8 EMA. That means the price can take some small support here and then it can go up. And again, whenever the price is coming down here, 8 can give support. But if 8 fails to give support, next level of a support can be observed at a 20 EMA. That means here the 8 got failed. Next level of a support can be given by 20 EMA, constant support by 20 EMA. And then again, when there's a pullback, again a 20 EMA support. And again, whenever the price is going above 8 EMA, 8 EMA started giving support here, 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 here. Again, when the 8 is broken, 20 is giving support. Again, the 20 gave support. That means if you see for the entire day, 8 and 20 are acting as a dynamic support levels on an uptrend. But how to figure out when to apply these levels and when not to apply these levels? All these will be applied in the 5 minutes time frame only. It is not in the 15 minutes. Till now, whatever we're discussing, everything on 5 minutes time frame only. So now, when to apply these levels means only in case of a trending market. That means either it has to be an upward trending market or it has to be in a downward trending market. So how to find out whether the market is a trending market or not? It's very simple. The first thing is, just if you see the market also, you'll be able to see that whenever the price forms any high or low level, that high or low level will be broken easily and will form a new high. That level also will be broken and will form a new high. That means whenever a new highs are getting formed, that is just a basic indication that the market is in a trending mode. If it is breaking the day highs and forming a new highs, that is called as a upward market, upward trending market. If it is breaking the lows and forming a new lows, then it's a downward trending market. In this case, this is the high level that got broke and one more high got created. After a pullback, that high also got broke. After a pullback, that high also broke. And here, after a pullback, it took long time to break that high. But still, it is breaking the highs and creating a new highs. So it is in a trending market, upward trending market. That is just by looking at day high and day low breakouts, you can get to know that. Plus, whenever the price is in a trending mode, you can see that the gap between these moving averages will keep increasing. So you can simply check the moving averages. Whenever the gap between these three moving averages are getting increased, that indicates a trending market. If there's a very big gap, that indicates a good trending market. That too, if the candles are trading above 8 EMA, that indicates that strength of upward trending market is very good, because the lines are moving in the upward direction, plus the candles are also trading above 8 EMA. That means the strength of the market is good. Even though it's uptrend, it could be there that slightly uptrend or a heavily uptrend, So whenever the market is trading above 80 MA, that can indicate a strong trending market. If the market is below 80 MA but above 20 MA, still we can say that the market is an uptrend, but slightly in the upward market only. It is not as good as a heavily trending market. We cannot call it as, but it is still a good trending market. That's why you see, till the time the market is above 80 MA, the price went very sharply. And once it came back below 80 MA, it was not that much, but still it is slightly going up. Again, the moment it is coming back to 80 MA, we can see till here. So if whenever the price is trading above 80 MA, that indicates a heavily trending market. That too, just because one candle, if it is trading above 80 MA, doesn't mean that we will assume that the price is in a trending mode. The gap also should keep on getting increased. So if it is moving in, if all the moving averages are showing an upward direction and the gap is getting increased, and then if you see the candlestick above 80 MA, then we can say that the strength is stronger. Just like that, if the moving averages are going down, and if any candle is below 80 MA, then we can say that downward trend is also stronger. So like that, we need to use these moving averages as a dynamic support and resistance points. And generally what we will be doing is, let's say if you are entering here, then you may keep your stop loss below 80 MA or below 20 MA. And every 15 minutes, you can keep trialing the stop losses without worrying about anything else. Let's say when the price is breaking 80 MA, then what is the next level of a support? 20 MA. So you'll be keeping stop loss few points below that 20 MA level, and you can keep trialing that. And you forget about any resistance level that you may have on the top direction. You can completely ignore all those levels, and you can simply keep trialing your stop losses below the 20 MA. If it is getting touched your stop loss, you will exit it. If it is not touching your stop loss, you can even trial that till 3 o'clock also, till 3:15 also, you can trial it, not a problem. Because sometimes the market trend will continue till the end of the day. So if you want to capture the entire move, then you need to use this trialing methodology. But that kind of a heavily trending market might not happen all the time. But whenever it happens, you can use this particular technique to trial the stop losses continuously till the end of the day. Or in between, if any candle touches your stop loss, you will be exiting at that particular level. And what is the importance of 50 SMA? 50 SMA will be used to find out the trend reversal or a trend change. Using that, we have one strategy, which is a strategy number 11 that I'll discuss when I discuss about the strategy number 11. But here we need to understand just about the 20 EMA and 80 EMA, how to use them as a dynamic support and resistance levels, and how to find out whether the market is in a trending mode or not using those levels, plus how to use them as a trailing stop loss method, because we know that there is happening, but to use that for a better manner, we can use as a trailing stop loss method so that we can capture the entire move. Now to enable this indicator in your trading view, there is no specific reason for 8 EMA or 9 EMA. It is just based upon the experience only. So you can also say that why not 10 EMA or 11 EMA or 13 EMA, or why not 21 EMA and all that. It's just based upon experience. We observed that instead of any EMA, we thought that 8 EMA was doing in a better manner. It just based upon the back testing, you will understand. And then here, if you want to enable that, go to the indicator section and then search for SMA by KGS. So you'll get one more indicator, 5 MAs in one indicator. Click on that. So once you click on that, you may see multiple lines like this. Then just go to the setting of that indicator. And here, go to the settings. Then go to the style section first. Then we just need one SMA. So disable the rest of the SMAs. And we just need 2 EMAs. So disable everything else. So now we have 3 lines, which is one is SMA line. The 2 are EMA lines. EMA lines are one is blue and one is green by default. So keep like that only. I mean, you can change whatever the colors you want, but I am just showing what the colors which we use. Then go to the SMA one and change it to red. So here the colors are over. Then go to the inputs. Here we need to give the values. So for SMA one, we need 50 SMA. And for EMA one, already 80 is there. And EMA two, already 20 is there. So these are perfectly there. Just for the SMA one value, we need to change. And the style section, we have already changed it. So then click OK. So once you click OK, then this is how the moving averages will be visible to you. Now regarding how to use this for a trading strategy that I'll discuss when I discuss about the coming, when I discuss about the coming strategies, then in the strategy number 11, we'll use this, but this is how you will be enabling the moving averages. Okay, now we discussed, because why we are discussing so much until now, even though almost 1.5 hours got completed and we are just completed only one topic till now. But that's how, because if you know about these 3 topics now, then the strategies are nothing. They are just like it will complete within 30 minutes or like that. But understanding these things are very key. Otherwise, you might not be able to even though if you know the strategies, you might not be able to deploy that properly if you don't know why we are using the strategies. Otherwise, without discussion of all this, I can simply discuss the strategies and then close it off. But you need to know these levels in detail, then only you'll be able to better utilize the strategies which are being mentioned. Now we need to discuss about one more important concept called as a breakout and a false breakout. This is also a very key concept because many people will fail to figure out what is the proper breakout and what is the fake out. Let's come back to that level, which is discussion upon false breakouts. So there could be multiple things. Let's say whenever I say that when there is a breakout, so out of the 10 strategies or 11 strategies, whenever I say when there is a breakout, take an entry, take a long entry or take a short entry, etc., I mean that you will be aware of all these fake out concepts and breakout concepts. Then only you will be able to know when to enter a particular trade and when to avoid any particular trade. So let's say whenever there's a key level could be any resistance level or any support level. So in this case, let's say this is a key level of a resistance. And whenever there's a breakout candle, if that breakout candle is a too big candle like this, you should not be entering a breakout trade. That means at this point, you should not be going long. Even though our strategy got triggered, that means we have 11 strategies, right? So even though our strategy got triggered, but when the breakout candle is a very big candle, then you should be avoiding taking that particular trade. Even though the strategy says to go long, you should not be going long because the breakout candle also we must understand. It's not because any candle we should not be going long. We should be waiting for a right candle, then only we need to go long. If that breakout candle is a very big candle, you should not be taking the trade. We should be avoiding the breakout trade. So if you see, all other candles are medium-sized candles, and suddenly at a key level, we can observe a very big candle. So it's not a right time to go long because most of the times it can happen that price can reverse completely because that kind of a big candles will generally be created by a institutional players to trap the retail people. So to know whether it's a trap or not, we need to at least wait for the price to retest and continue. If the price is, let's say, retesting and then continuing and forming a good breakout candle again, then here you may try to go long again. But avoid going long at this breakout candle whenever the candle is very big. That is one thing. Second thing is, whenever at a breakout level, you see a candle, which is a bull candle, and in this case, you can see that it's a green candle. But you see a wick on the top side, a long wick on the top side. That means even though there's a good body for this candle, then also we should not be going long here. The reason being, when you see a long wick on the top side, which is almost equal to or even more than the body of the candle, whenever you see a top wick, which indicates a selling pressure, because how the candlestick form is, this is the opening level for that candle, this is the high, and this is the low, and this is the close. So these are nothing but OHLC values. So if you see, this is the price opened, and price was going all the way, and from here there is a sudden fall. And price has closed over here. That means all this upside when there is a wick, right? It is nothing but the sellers who are present over here are not letting the price to go up. They have created a wick on the top side by pushing down the price all the way from here to here. That means this area is as of now, it is indicating a selling zone. So even though there is a proper breakout over here, even if our strategy got triggered, we should not be going long at this breakout candle because there is a wick on the top side. At the same logic, we can use it for the support level also. If let's say there is a breakdown candle, bearish candle at a support level, and there is a long bottom wick, here also we should not be going short because when there is a bottom wick, which indicates that we should not be looking for a short opportunity. But let's say after this, if it is a few candles, if it is breaking this level, then maybe you can look for a shorting opportunity. But here what happened? Most of the times when this happens, it could be possible that it can result in a fake out. That means the price can come back into the range. So if you go long here, it could be possible that your stop loss might get hit. So that is also one thing you should be avoiding long wick breakouts. And these conditions also should be satisfied. That means the breakout candle has to be a momentum candle. Momentum candle means the body of the candle should be good enough. It should not be like a very small body. For example, if you see this body, or if you see this body, or this body, these are very, very small bodies. These cannot be considered as a momentum candle. Momentum candle means the body will be decent enough. Like if you see this body is big, wicks are smaller. Here also the body is big, wicks are smaller. This is also a good momentum candle. This is also a good momentum candle. This also could be a good momentum candle. These are momentum candles. But if the body is very, very small, that is not called as a momentum candle. Momentum candle means the body should be bigger, the wicks should be very smaller, and it should not be having very small body like this, like this, like this. These are not momentum candles. Plus, the breakout candle has to be a momentum candle. Plus, this is more important. The breakout candle, when it is getting a breakout, more than 40 to 50% of the body has to break the level of that particular level. For example, if you see, this is the key level of a resistance. Now, when this candle is a momentum candle, and it is also not having any long top wick, it's also not a very big candle. So all the conditions are getting satisfied. But the only problem is this condition is not getting satisfied. More than 40 to 50% of the body of the candle has to break above that particular level. So since it's a resistance level, there should be at least 40 to 50% of the body should be above that particular level. But in this case, if you see, only 5 to 10% of the body is above the level, rest of the body is below that particular level. So here also, even though it's a momentum candle, we should not be going and taking the trade because it is not called as a proper breakout. Only when all the conditions are satisfied, it has to be a momentum candle. More than 40 to 50% of the body has to break the level, body of the candle, not the wick of the candle, not the total range of the candle, only the body of the candle we need to consider. 40 to 50% has to break above that particular level if you are going long. If you are going short, then make sure that 40 to 50% of the candle body should be closing below that particular support level. Plus, it has to break the previous wicks. That means if you see why this example is taken is, here the first breakout candle, we will not be going long because this condition did not get satisfied. Then what happened? The price make a small pullback it made. And then again, if you see, this is the high level. This is the high it has formed. That wick, I mean, even though it's a small wick, we can say that actually there is some data which is going off here. Let me show you the exact example for this. Somewhere over here, I think. Yeah, this is the example for that. So if you see here, this is the total data. So if you see, the first candle could not break properly, and then there is a wick formation that has happened. So what we need to do when the price is coming back to this level, we need to extend this particular level. Only when if the momentum candle breaks above that particular level, then only we will be looking for a long entry. Let's see what has happened here. Here, this candle anyways will not be going long. Then we will be drawing a previous wick level. Now we will be waiting for the candle to break that particular level. It could not happen, but this candle could not break, but it formed a new wick on the top side. Now we will be waiting for price to break this wick level. That means that's the previous high. We need to wait for the candles to break that previous high. Now, if you see why we should not be going long at this candle, the reason is this is a momentum candle and this is a 50% of the body is above that particular level. That's also got satisfied. It is not having any long top wick. That also got satisfied. Plus, it's also not a very big candle. Everything got satisfied. But the only problem is it could not break above the previous wick level. These are the previous wick levels. It could not give a proper breakout above the previous wick level. That is the only reason we should not be going long at this candle, even though all other conditions are getting satisfied. That means even if there is one condition which is getting violated, we should not treat it as a proper breakout and we should not be taking the trade. We should avoid taking the trade at that particular candle. Now, if you see, there could be a very high possibility that many might go long here, and there could be a possibility that they might get a stop loss hit also. So here also, actually, this candle should not go long. This candle also not go long. This also not go long because 50%, it is also not breaking the previous high. This candle also you should not be going long. But this is very, very key because in intraday, many people might ignore the small details and they might impulsively take the trades. And that too, for example, actually this is an institutional level. And somebody might even enter here thinking that the price broke the price, made a gap up and made a pullback and made a breakout. So let me go long here. You should not be going long because there's an immediate resistance level over there. So there are many mistakes that people can do without having the complete knowledge, especially upon the key levels, plus the breakout and fake out levels as well. So this is how you should be avoiding the trades. That's because it could result in a fake breakout. And when we go back to this particular thing, so you should not be going long when it's a big candle, plus when there's a long top wick, then also you should not go long. Or when there's a long bottom wick also, you should not go long, go short. That means you should avoid trading at that candle. Plus it has to be a momentum candle. That means it should not be a very small candles like this. There should be a good momentum candle should be there. Then 40 to 50% of the body of the candle has to break that level for a better confirmation. If only 10% of the body is breaking, but 90% of the body is below the level, then we should not be going long. Plus, it has to break the previous wick level in order to confirm that particular trade entry. If it is not breaking the previous wick level, then we should not be looking for a trade opportunity. These will really help you if you can actually understand this properly and try to implement. You will see that many of the fake trades could be avoided very easily. Now, just because there's a fake out doesn't mean that immediately you will go ahead and then short it. There's only one strategy where you will be using the fake outs for taking a reversal trade that we'll discuss, which is based upon the institutional levels. So because it can happen that we cannot exactly say just because of a fake out, for example, let's say here the price made a fake out and came back to this level. So if you go short here, what if the price goes up like this? Because still if you see the trend is up and only, it's going up, making a higher high, higher low, higher high, higher low. So what if it creates a new higher high and higher low like that? Just because it's a fake out doesn't mean that price will come back to this level. We need to have further confirmations to say that the trend got changed. Fake out doesn't mean that trend will change. Fake out means that it is not a proper breakout. But that doesn't say that 100% the price will reverse completely. Whether the price will reverse completely or not will depend upon other factors, like we need to have two more confirmations. Whenever the price is breaking here, first thing is we need to draw a trend line. So we need to make sure that the price is breaking the trend line. Plus we need to also make sure it is breaking the previous swing low level. That means if this is a swing low, then we need to make sure that price is breaking that swing low plus it is breaking the trend line. Then we can say that, okay, it's a fake out, plus it broke the previous swing low, plus it also broke the trend line. Now we can say that trend can change because whenever the trend line gets broken properly, we can assume a trend change. Then you can look for a short entry opportunities. But just because of a fake out doesn't mean that you will immediately go and short that particular trade. Then finally, you also look for these two things. That is, whenever the candle is trying to break any particular level, you wait for the candle to close completely. Don't immediately jump into that particular trade. So in this case, if this is a 5 minutes time frame, then this candle at some point of time, let's say in the 4th minute or 5th minute, might look like this, because it might look something like this. So without the closure, don't immediately jump into that particular trade thinking that it is breaking the level. If you take that, there could be a possibility that price might reverse. If it reverses, you might end up hitting the stop losses. What you need to do, just wait for the 5 minute candle to close, then you will get a confirmation. So if you see at the end of 5 minutes, there is a small wick that has formed. That means what? The support level is still not getting broken properly. Then again, it could not break, the price started to reverse. Then you will obviously, if you wait for candle to close, then you will know whether to take an entry or not. Here also that example you can see. 5 minutes candle, if you see this one, it is going down. Let's say if it's a support level, at some point of time, there could be a possibility that you might see the candlestick like this. And if you think that, let's say on the 4th minute beginning, you saw that the candlestick is forming like that. And impulsively you thought that, okay, the 4th minute itself, it is breaking like this. By the end of 5th minute, you might assume that the candlestick will go till here. So what you do, you might end up taking a short trade here, but you will see that within few minutes, your stop loss got hit. That is because if you could have simply waited for the end of that candle, then you will definitely not go short at that particular point because the price itself could not even break that support level. So you will obviously wait, and then since there is no shorting opportunity, you will not be looking for a short trade around that particular level. These are the things that you need to keep it in mind whenever we talk about a breakout. So we need to make sure that, so when I say that when there is a breakout, take the trade, that means it should not be a long candle. It should not be a long wick candle. Plus it should be a momentum candle with 40 to 50% of the body above that level. Then it has to break the previous wicks. If all these conditions are getting satisfied, then we can try to look for a breakout entry. And even after looking at all these levels, sometimes it can be possible that even after that, suddenly the reversal can happen because of the volatile situations of the market that is currently in. In those cases, maybe you can look for a reversal trading opportunity when these two conditions are getting satisfied. That means when there is a fake out and if it's getting reversed, and when you see the trend line breakout, plus when you see the previous swing low, that level that is getting broken out, you may even look for a reversal trading opportunity also. Now let's discuss about the other concepts. Yeah, only one small concept is there. After that, we'll start with the 11 intraday strategies in 5 minutes time frame. So which is how to place the stop loss, because you will go and take the trade, but you must be knowing where to keep the stop loss, right? If you see till now, whatever the levels that we discussed, as I said, every level will be either support or resistance level. That means if you see in daily time frame, support and resistance level, and gap up and gap down, support and resistance levels, especially these levels, previous day high and low level, current day high and low level, CPR and virgin CPR, institutional levels, and EMA, SMA will act as a dynamic support or resistance levels. Now, all these levels will be useful for you when you are keeping the stop losses, because the rules of stop loss is when you are going long, when you are going a long trade, and your entry level, between your entry and between your stop loss, there has to be minimum one level of a support should be there. Now, support can be anything, which can be CPR or support zone, demand zone, or moving averages or institutional zones, or a previous day high once it got broken, that also can act as a support level. It can be anything. But between your entry point and between your stop loss, there has to be minimum one support level. Maximum it can be 2, 3, or anything it can be. The more it is, the better it will be, because those levels will act as a security for your stop loss. That means this level, if there is a support level, and if when you entered here, even if the price is making a pullback, it might take some support here and then it can continue, so that your stop loss will be secured. That means when you're going long, look for immediate support level and place your stop loss few points below that particular level, so that your stop losses will be secured. So same like that, when you're going in a short trade, you need to make sure that between your entry and between your stop loss, there has to be one or more level of a resistance level. That means if you're going short here, and if this is where you want to keep stop loss, in between your stop loss and resistance level, I mean entry level, there need to be one kind of a resistance, or it can be more. Now resistance can be anything. Again, it can be a supply zone, it can be CPR, it can be moving averages or institutional zones, etc. Or any support level which got broken can also turn into resistance. Now even the swing highs and swing lows also will act as a resistance levels or support levels. For example, the price will go up and make a swing low, swing high, swing low, and swing high and swing low. Now these levels are also nothing but a support levels, minor support levels. So this also can act as a support level. You can even place your stop loss below these levels also. And when the price is going down, the swing high levels will act as a resistance levels. That means you can place your stop loss above the swing high levels. So these levels also can be considered as a support or resistance levels. Not only the levels which we discussed, these swing low and swing high levels also will act as a minor support and resistance levels. And then how to keep the targets. Targets, nobody can say that you get 1:2 or 1:5 or etc. because depending upon the market situation, we will be getting to know how much profit or how much risk reward you are getting. So that depends upon trending market. Generally, if the market is in a good trending mode, you might get more risk reward. If the market is completely volatile or sideways, you might not get good risk reward also. So it actually depends upon the market momentum. You cannot say that just because you assume that you need to have 1:3 trade doesn't mean that you might get 1:3 trade. It depends. Sometimes you might get 1:1 trade. Sometimes 1:4 you might get. Depending upon how the markets are moving, you will get that. And on average, generally make sure that you have an average 1:2. That means not that every trade you need to have 1:2 or more than that. Sometimes you might have lesser, sometimes you might have more. But if you take, let's say 100 trades, your last 100 trades, and check how much is the risk reward for each trade. And when you average it, then you must know that at least you are maintaining an average of 1:2 or more than that. So that is the average. It's not that every trade you need to get 1:2 or like that. But in intraday, especially, even if you get 1:2 trade, that's a good risk reward ratio. That means if you want to exit at 1:2, you can exit at 1:2 because for intraday, don't look for too much like 1:5 or 6, etc. Sometimes it will reverse and then even your stop loss might get hit if you wait for too long. Especially in case of a sideways or slightly trending market, 1:2 is a good risk reward ratio. But when the trend is stronger enough, then we can get 1:3 or 4 like that. Because when the trend is strong, we have explained how to use the moving average technique, 8 and 20 moving averages, so that you can keep trailing the stop losses without worrying about anything else. You can keep trailing till 3 o'clock or till the time when the market is continuously trending. Then you can trial it so that you can get more risk reward. But sometimes it happens that in case of a range bound market, you might not get your target hits very easily. Sometimes it will be in range bound for more time. In that case, suddenly sometimes you can get a good breakout and you might get 1:2 trade also. 1:2 risk reward target might get hit. At that place, you might exit because in case of sideways market, we don't know when the suddenly it will reversal will happen and all. So 1:2 trades is a good in sideways market. And sometimes it can happen that you might be having 100 quantity. Let's say if you're trading in stocks and if you take 100 quantity, at 1:2, you might exit 50 quantity and rest of the 50 quantity, you can still be in that particular trade. And then you can trial your stop loss to the break-even levels for the remaining quantity, etc. So multiple ways are there. It's not like only one way we need to follow. There are multiple other ways are there through which you can like trial your stop losses or book some portion and trial the remaining ones. And in case of a trending market, you can use the moving average technique, etc. And here also like this also you can trial from one swing high to the other swing high. Let's say if you take a trade here and you kept the stop loss below the swing low, and once again when the price forms a new swing low and then goes up, then you can move your stop loss from this level to this level. Like that, whenever there's a new swing low, you can keep trailing your stop losses from one swing low to the other swing low. That's also one method to trial the stop losses. So that's a multiple ways are there. It depending upon the market situations, you need to follow the different ways. But 1:2 in general is a good risk reward ratio. Anything more than that is also very good. Okay, now, so it is 9 now. So now we'll be taking a quick break for 10 minutes. Then after that, we'll be discussing about these strategies, 11 strategies we'll discuss. Now it is 9, right? Okay, around 9:10 we'll be back. And then we'll discuss with the strategies. Hi everyone. So let's continue further. Yes, the recordings will be shared in 1 or 2 days, not a problem. Okay, so now let's discuss about the 11 intraday strategies. All these strategies are 5 minutes time from the strategies. Now the first one is, so we have divided this into 3 parts. Actual total 4 parts it's divided into. So let me share the details. So now, so we have part number 1, which are 1 to 6 strategies, which are based upon the gap up or gap down markets. Then like 7 and 8 strategies, these are based upon the CPR. Then 9 and 10th strategy is based upon the institutional zones. Then the 11th strategy is based upon the moving averages like SMA and EMA concepts. So this is how it is going to be. So first let's discuss about the 1 to 6 strategies which are based upon the gap up and gap down markets, which can be applied when there is a market made a gap up opening or a gap down opening. So these kind of strategies can be deployed easily. The first one is gap up bullish. So for every strategies, there will be logic behind that as to why we need to use this particular strategy. What is the understanding price action concept behind using this particular strategy? Now gap up bullish means, as the name says, the price will make a gap up opening and we will be looking for a bullish opportunities. That means we'll be looking for a long entry opportunities. So in these cases, the first candle or the subsequent candles, the first you will see a bullish candles. In after a gap up, you will see bull candles. Then in this all 1 to 6 strategies, we need to wait for both bull candles plus bear candles as well. We will not be taking any trade just based upon one particular type of candle. We will be looking for the other type of candle also. So first candles are bullish candle means we need to wait for the proper bearish candles to form. And then we'll see if the bears are strong enough or if the bulls are strong enough. Because gap up, just because the market made a gap up and a bull candle, doesn't mean that the market is going to go in the upward direction. It can happen that after that the price can come down and then completely it can crash also. It can also happen. But we need to have at least some confirmation as to who are stronger enough. So for that, we need to see the bear candles as well. Then we need to mark a day high. And then if you see any proper candle which is breaking this level, then only we'll be going long. That means whenever I say that a proper candle breaking that level, that means we must know that all the breakout concepts properly. It has to be a momentum candle. It should have 40 to 50% of the body breaking above that particular level. Then it should not be having a long top wick. It should not be a very big candle. So all these conditions, if it satisfies, it should not be any of these candle. It should be a normal momentum candle with 50% of the candle above that particular level. Then we can go long at that particular level by keeping a stop loss. So whenever you need to keep a stop loss, you need to make sure that what is my immediate support level. So when you're going long, you need to look for the immediate support level. And in case of Nifty, you can place 10 to 15 points below that particular level. You can place your stop loss. So like that, in case of Bank Nifty, 20 points below that particular stop loss, you can place it. That means the reason logic is, if this is a support level, don't touch that particular stop loss and then keep it. Have some small buffer so that even if there's a small wick that's getting formed at the support level, your stop loss will be secured. So that is the logic behind keeping some buffer space below your support level when you're going long. And this might look something like this. The gap up will form. First candles could be bull candles. Then we need to wait for the bear candles to form. And if you see the price before breaking this level, it has formed a new wick on the top side. Then we need to wait for that wick level to break properly. So we see this candle, which we can see 40% of the body, and this is a good momentum candle. It is not having any long top wick. It's not a very big candle. Plus it's also not a very small candle also. Plus 50% of the body, we can see that above that particular level. So here in this case, we'll be going long. That means if you are trading in Nifty or Bank Nifty, that means you'll be looking for a call option buy. And where to keep the stop loss? So you'll be checking what is the next level of a support. So if you see, when there is a pullback, that also can be treated as a support level. So you can keep your stop loss below that pullback level. So your stop loss will be secured to some extent. And depending upon the market conditions, if let's say if the market is trading above your 20 EMA or above 8 EMA, then you can use this trailing stop loss methodology to trail your stop losses like this. But if the market is not trading above ATMA and all, if it's a range bound market, then what you will do till the time you will get 1:1 or 1:2, depending upon how the market is moving. You may even exit some portion at 1:1, some portion remaining portion you might exit at 1:2. Like that also you can look for that. But if the market is in a trending mode, then you can use that moving average concept to trial your stop losses. Yeah, when you are looking on options chart, how to replicate the stop loss from the spot chart to the options chart, that we will discuss after these 11 strategies. I'll tell you how to replicate that particular thing. Here the prior trend is bullish. Will this strategy work if the prior trend is bearish? Will not be there any probability of a fake out. See, obviously the prior trend is a bullish trend, right? If the prior trend is a bearish trend, how will it break the day high level? If it is breaking the day high, that means there has to be some kind of a bullishness. And we can completely ignore what was the trend on yesterday. So if you're talking about yesterday trend, then we can completely ignore that. We just have to see if it's making a gap up or not. Yesterday, the market could be completely in the downward direction also. But today, if it's making a gap up, then we'll follow this particular thing. Our strategies, this particular strategy is not going to do anything with what happened on yesterday. Just we will be checking whether it's a gap up or not. And if there's a gap up and if there's making a pullback and continuation, plus the breakout candle here, it is very important. You should not be looking for all those fake breakouts. Here we'll be avoiding most of the fake breakouts because we have only a proper momentum candle 50% above that particular level, which is not having a long top wick, which is not a very big candle. So all these conditions, if it satisfies, then only you'll be going long. Plus, there is one more thing that you need to focus upon. If you're taking, this is also very important. If you're taking a long trade here because your strategy got triggered, strategy number 1 got triggered, but just above that particular level, if you see any major resistance level could be previous day high or institutional resistance zone, or it could be, let's say CPR. If it could be anything, if just above this particular level, not previous day high, that means it could be anything for that matter. If it is there, then we should not go long. But how to decide that particular range? The thing is, if you're going long here, first calculate how much of the stop loss that you're keeping. That means, let's say we're keeping, for example, 40 points of a stop loss. Then till the next 40 points on the top side, you should not have that resistance. That means, let's say CPR could be there over here, not a problem. But till 1:1, you should not be having a major level of a resistance. It could be CPR or institutional zones also. If the institutional zones is, let's say over here, then we will not be going long, because even if you have to take 1:1, that 1:1 trade it's also is not working out, because stop loss you are keeping 40 points, and before reaching 40 points of a target, you have a resistance level just above that level. Then you should not be going long. But let's say institutional zone level is above 50 points. That means around 60 points of level. There's an institutional level. Then there's not a problem, because at least 1:1, the route should be clear on your direction. There should not be a resistance in the side of the direction which you are taking the trade. What level of difference between the open and close can be considered as a big candle? Big candle, there is no specific level or points which can be applicable for everything. But the moment you see any candle which is more than 2 to 3 times, more than 3 times or 4 times of an average candle, then you can say that that is a big candle. For example, if you see any of here, none of these things are considered as a big candle. But this one, if you see, this candle could be a big candle, because it's clearly more than 2 times. On an average candle, if you take, it looks like more than 2 times of an average candle. But here it is nothing is not that much bigger enough. Sometimes here, this candle, if you see, the big bearish candle, here a big bullish candle. So you can clearly find out by look, because in Nifty, the candle size could be looking different. In any particular stock, the size of the candle will look different. The main thing is the moment you see the candle, you'll be able to find out that it is more than 2 times of the average candle range of that particular instrument. Then we can find out that it's a big candle. There is no specific points or percentages that we can assign, because depending upon the instrument, that will keep changing. Gap up opening in the first candle is a bearish. if there's a gap up opening and if the first candle is bearish, then we will be having other strategies. So this is only strategy number 1. So we have remaining 5 strategies for gap up and gap down markets. So that we'll discuss there. And strategy number 2 is gap down bullish. That means the price will make a gap down opening. Then the first candle will be a bullish candle. So just like the gap up bullish, just the only difference is it will form in a gap down scenario. Now gap down also bullish candles might form, then a pullback candle can form. Then you will be marking a level on the high and then there is a breakout of that particular level. Then you will be going long by keeping the stop loss below the previous swing low or below the previous support level. Then for example, it might look like this. So you can see very huge gap down that has happened. So bull candles are getting formed. But just because the bull candles are getting formed, it doesn't mean that you will be taking a long entry over here. You'll be waiting for the price to give a pullback and wait for the bearish candles also. Because as I said, for every strategy, we need to wait for bull candles as well and the bear candles as well. Only based upon one single type of candle, we should not decide the trend of the market. So here after the bearish candles, if the bears are stronger enough, what can happen? The price can come down like this and it can break the day low and it can come down. But again, even after the bears are stepping in, again the bulls stepped in and then broke this high level and formed a new candle breakout has happened over here. So if you see this candle is having 50% of the body, it also broke the previous wick level, plus it is not having any top wick, plus it is not a very big candle. It looks like all the conditions are getting satisfied. So here you can go long by keeping the stop loss below the support level. So like that. So in this case, it is not a good trending market because trending market means it will continuously trend like this. In this case, what happened after till 2 hours of your taking the trade, it's a range bound market. After that, suddenly there is a breakout. So at this point of time, you might get 1:2 target hit. So generally, since it's not a trending market, and then you got a 1:2 suddenly, you might even exit at that 1:2 also, because we cannot expect that the market will continuously going up because it's not a clear trending market. In clear trending market, we can use the moving average method to keep trailing the stop losses. But in these cases, in this kind of a market, suddenly the price can reverse also. So 1:2 if you are getting in intraday in non-trending markets, that's a good thing to even close the trade also. That is one thing. Yeah, all the notes, whatever the discussion that I'm making will be discussed over here as to why we had logic, what is the logic behind this strategy, why we'll be considering that. So once you read this, you'll be able to understand in a better manner. The logic is very simple if you can really understand what's happening. So if you see for this particular scenario, gap down bearish. So what happens when there's a huge gap down that happens now? It can happen that the gap down might be because of the global factors, or it could be also because of whatever the events that is happening after the market hours, because both combined, there could be a gap down opening. Just because the market made a gap down opening doesn't mean that today the market will completely go in the downward direction. So we don't know. It could be because of global markets, there could be a gap down opening, or it could be any other reason. But once the market opens, then the buyers and sellers of that particular day will decide to take the market on the downward direction or on the upward direction. Let's say if the markets are having very bad sentiment or any bad news is impacting the market, then it could definitely be possible that after this, even though some bullish candles are getting formed, it could be because of the profit booking. It can happen that people who have bought put options might book some profit so that the market, this could be profit booking. But if the market is really bearish, then bearish candles will form and it can continuously go down like this by breaking the day low. So in that cases, we'll not be looking for long entries. But in this case, what happened? Even after the bearish candles could not break the day low and then go down. That means there is a profit booking, that is okay. But after that, again, the bulls are entering. New positions are getting created. That is a confirmation that the market is not completely bearish. It is even bullish only. This is a confirmation to confirm that we can even look for a long entry opportunities. That too, when the markets are opening in some direction and it is moving towards the gap level like this, in this case, there's a gap down. And if it is trying to fill the gap, it could be possible that sometimes the market gap filling can happen on the same day. Sometimes it can happen on the next day. But gap filling also is possible when now this kind of a recovery happens. No, on the next day, the recovery can also happen. The market can either open a gap down and recovery can happen, or sometimes the market will open a huge gap up and also fall also can happen. So in these cases, both are market filling. That means the gap is getting filled up. So in this case, this is a market filling strategy basically. That is, even though there is a gap down, the market is filling the gap. So you are looking for an entry point or a confirmation to enter, because just because of a gap down opening and one bullish candle doesn't mean that it is going to fill the gap. You need to wait for both bulls and bears and then find out and form an opinion. That opinion can also might go wrong, because it doesn't mean that all these strategies will work 100% of the time. Even after taking a trade here, it could also happen that your stop loss might get hit, because nobody is 100% certain on any particular thing. But the probability of winning based upon the backtesting data is much better if you follow that breakout concept. If you follow that, if let's say there's an immediate resistance, if you're not trading, if you're following all the strategies properly, concepts, then the probability of winning is better than the probability of losing. So, and that too, when you're risking, you should not be risking generally either 1% of your total capital or 2% of your total capital is the maximum risk that you need to take for any one particular trade in intraday. You should never exceed 2% of your total capital as a stop loss in intraday. That risk management concept you cannot violate, because if you are violating the risk management concept, then it can happen that within one day you can even lose 10 to 20% of the capital also you might lose. But there should be a limit as to how much you are losing, because in intraday we don't have a gap up and gap down risk. That means we are not carrying the positions overnight. That means we can control the risk how much ever we want. If let's say you are carrying a forwarding a position, then because of a gap up or gap down, you might even lose more than what you are supposed to lose. That will not happen in case of intraday trading, because in intraday you know where to keep the stop loss and you can control that. But it might not happen on the overnight positions. It will definitely happen in the intraday. So don't risk for the beginners, not more than 1%, or if you're having little, not that much big capital, if you don't have, then at least at max, you can go for 2% of your capital as a stop loss for a particular intraday trade. Then the third strategy is bullish base violation. This can form in case of both gap up market or also in case of a gap down market. This kind of a bullish base violation can be applied. In this case, what happens is either the price can open with a gap up or a gap down, but the first candles will be bearish candles. So first candles will be bearish candles. Then what I said, we need to wait for a bull candles also. Then the bull candles will form and directly it will break the day high and it will form a breakout candle around the day high level. It can happen both in upward, gap up and gap down also. That means even though first candles are bearish candles, immediately bull candles have stepped in and then it broke the day high and it started to go upside. So here is where the strategy number 3 comes in, which is called as the bullish base violation. This also is a long entry opportunity. So this is how it can happen. In this case, there's a gap up, but bear candles are getting formed. So after the bear candles are getting formed, we can see a reversal that is getting happened. And here, if not this candle, even this candle also can be an entry candle. Because if you think this is not a momentum candle, then this candle could also be your entry candle because this is a momentum candle. So if you go long here, you can check what is the previous level of a support level, and you will be keeping your stop loss below that particular level. And this could be a trending market that we need to apply 20 or 8 moving average and then check out whether it's a trending market or not. It could mostly be a trending market because yesterday also the market was in upward direction. So the moving averages could be coming like this. So if the market is in a trending mode, then you can use the trailing stop loss methodology to trial the stop losses and then capture the maximum extent of the trend possible. Now for examples, we'll take later, like all the 6 strategies once it gets completed. No, then I'll show you some of the examples and then I'll ask you, well, out of 1 to 6 strategies, what strategies can be deployed on that particular day. But let's complete the 6 gap up and gap down strategies first. Then comes to the, so 1 to 3 are bullish strategies and 4 to 6 are bearish strategies. Now, if you see, strategy number 4 is a gap down bearish. In gap down bearish, the first candles will be bearish candles. Then we'll be seeing a bullish candle as a pullback, but it could not sustain further and bears will step in again and it will break the day low. So day low will break and form a momentum candle, then we can look for a short entry opportunities, provided there is no immediate support level just below your entry candle. So it might look something like this: bearish candle, gap down bearish candle, then bull candles. It could not break the day high properly. Proper breakout means what? Let's say if this is a day high, then we need to have a good momentum candle breakout like this. That could not happen. And the price came down, and here there's a breakout candle which broke the previous wick levels also. And we can see that more than 50% of the body is below that particular low level. So here could be your entry candle. And depending upon where there, in these cases, sometimes you need to see that. For example, let's say you entered here, short trade, and you want to keep the stop loss because you thought that this is the swing high level. And if you want to keep the stop loss over here, that might not be practically possible all the time, because maybe it can ask you by 100 points of a stop loss. 100 points or more than 100 points of a stop loss in intraday trading is not a very good risk reward that you can risk. For that much of a stop loss, you cannot take it. So in that cases, what you need to do, you need to find out, is there any other way to keep my stop loss, any other logical way? It should not be like, okay, let me keep 20 points or let me keep 30 points. That kind of a arbitrary stop loss, you must never keep it. You need to have some basic price action logic behind how you are keeping these stop losses. So if you see, when there's a gap down opening and there's a good long bottom wick indicating some buying strength, and again there's a bottom wick, again a bottom wick, again a support, again a support. That means this level is trying to act as a support level. Once the support level is getting broken, the same support level can now act as a resistance level, is the basic price action understanding. So if you treat this as an immediate resistance level, then instead of keeping the stop loss here, you can also keep your stop loss above that. This is the resistance level, right? So above that resistance level, you can keep your stop loss. In that cases, you will be risking only 30 points or 25 to 30 points or maximum 40 points. It could be the risk. So whenever the stop loss is asking more than 100 points or more than 90 points like that, then definitely in between that particular level, you might find out other key level using which you can place your stop losses. But don't immediately assume that, okay, let me keep 20 points or 30 points or 15 points as a stop loss. That should be avoided. You need to have some logic behind why you are keeping stop loss at a particular level. No, in these cases, you need not wait for the pullbacks, because pullbacks might not happen all the time. In case of a 1-6 strategies, you need not wait for the pullback. All that proper breakout concepts, if you apply properly, then you can go ahead and then take the trade. And strategy number 5 is a gap up bearish. That means strategy number 4 only, but it forms in case of a gap up market. So in gap up market also, the price first will be bearish candles, then a pullback will happen, and then it will break down here, because the pullback is already happening here itself. We're first confirming that whether the trend has been bearish or not. Then after the breakout of that particular level, that too, if it's a proper candle, it could happen that many times the breakout candle might not be a proper candle. It could have a long bottom wick, or it could have a very big candle breakout can happen, or the 50% of the body might not break properly. So many fake breakouts can happen, but we're avoiding all that and we're only focusing upon the proper breakdown candles. So gap up bearish will look like this. So if you see this, continuously the price is coming down here, but it is not suggested to just because the price is coming down and let's say you entered here. What if immediately the bull candles comes and breaks the day high and then goes up like that? Because you actually don't know whether when the price will take a reversal and then completely go in the one direction. We are just making some assumptions and probabilities based upon the previous data and assuming that, okay, if this is happening, most of the time this is happening. So let me follow this particular strategy, because we need to stick to particular thing. We cannot keep on changing our mind depending upon the each and every particular day. In that cases, your strategy will not be there. You will be just how your mind is saying. You'll keep changing your strategies, and that will definitely not work in the future. You need to have a proper strategy. Entry and exit point should be there. Proper risk management should be there. And you should not get panicked or you should not get worried about the outcome of that particular trade, because you're ready to lose that particular amount. Means no matter, even if the price is coming and touching almost near to this, you should not be worried and then changing your stop loss from here to here. All these things you should not be doing it. If it is setting your stop loss, you'll be exiting and then looking for the other trading opportunity. If it's not hitting your stop loss, then you'll be looking for the target levels. So when the target level achieves, you can even exit that. That kind of a conviction you need to have on your strategies. If you keep changing the strategies or following the wrong stop loss management, etc., it can happen that even though you know how to trade, or even though you know how to analyze the strategy, you might end up not making profits. That could be because you're changing your strategies during the live market. That will not work out. If you see, this is a gap up bearish where the price made a gap up opening, and it happened that the price all bearish candles are forming. Then there's a pullback. If you see properly, there is a pullback that happened here itself. Then what we will do, we will draw a line over there. If there is any momentum candle breaking this level, we will enter the trade here itself. But what happened here, the price could not break that low level. And then before breaking that low level, there is one more candle which has formed a bottom wick. Now, this is not the important level. This will become our important level. Now we will be waiting for the momentum candle to break this level. So this candle also, we will not be taking a short trade because this broke this low level. But the problem is it could not break the wick. This is the wick level. So this candle could not break the wick. That's why we'll be waiting for one more candle. So this is a momentum candle which is breaking the previous wick. Plus it's also breaking, 50% of the body is below that particular level. Then you will be going short over here. And here you can simply see that above this, there is a clear resistance level we can see. So two resistance levels are there. So you'll be keeping some points, your stop loss above that particular level. And you may see that for almost most of the times you might not get the profit, but suddenly depending upon the market situations, you might get it. So if you waited for all the till the end of the day, your stop loss is not getting hit. So it's not a problem. You can wait for the till the end of the day. So mostly around 3 o'clock, it got hit. So sometimes it happens that you need to wait for till the end of the day for you to get profitable or getting the stop loss hit. It might not happen immediately. So patience also should be there to manage the trade. How to calculate the stop loss in options, I'll explain that once all the strategies are completed. I'll explain that. Then sixth strategy is bearish base violation. Bearish base violation is opposite for the bullish base violation. So here what happens, it also will form either in the gap up market or in case of a gap up down market also it can form. Then first candle will be a bullish candle. The first candle will be a bullish candle. Then we will be waiting for the bear candles as well. Then the bear candles will step in, but after that it will break the day's low and forms a momentum candle like this by breaking the day low. Then we'll be looking for a short entry opportunity. So here it will look like this. So if you see, there is a gap up and bull candle is there. Then continuously bear candles are there, which is breaking the day low. But we don't enter at this candle because one thing is, this is 50% of the body is not below this level. Plus, yeah, that's what, and like that's the main reason. Even if there's a 50% of the body, then what will happen? Then it will become a very big candle. So obviously, even if there's a 50% of the body below this level, that will become a very big candle. There also you will not enter. But the main reason is 90% of the body is above the level. So we will not be taking this trade. Then if you see, this is also not the entry candle actually, because this candle, if this is the wick, this is the wick level. If you properly observe, this candle could not break this wick properly. So this will become the actual entry candle because this is the wick level and there's a good momentum candle which is closing below this level. So this is where it will become your entry candle. And you can check that if you are going short here and if you generally keep the stop loss here, it doesn't really make sense because it lasts you more than 120 points like that in case of Nifty. So you need to observe what else can be the resistance level. If you see, there is a support level over here, price took support. And once the price broke that level, the same support level was now acting as a resistance level you can observe here. That means this is a new resistance level. If this is a resistance level, you can place your stop loss just above that particular resistance level so that if you're going short here and placing the stop loss here, it might ask you somewhere close to 40 points or 45 points like that. That's completely fine, not a problem. That's how the average stop loss points will be there in Nifty or Nifty. In Bank Nifty, it could be somewhere around 60 to 80 points like that. Depending upon the market's conditions, we cannot exactly say that every time it will be 40 or 80 points like that. But that is the strategy over there. Now, so 6 gap up and gap down strategies are there, right? So some are having a questions as to how the premium decay will be handled in these scenarios. You need not worry much about the premium decay in case of intraday trading because we will be selecting at the money options. At the money options will not decay so fastly. And in intraday, let's say if you're having 1 hour, if you are in that particular trade, in 1 hour, it doesn't have that. I mean, the decay will not be that much in 1 hour time frame. Generally, the decay happens over the period of time. That means for morning to the end, and mostly it happens overnight. Overnight, if the market opens here, I mean, if the market closes here, and tomorrow also if the market exactly opens here, then the premiums would have decayed by almost, depending upon on which day. Let's say if it's on Monday, it might decay by 10 to 15%. If it's on like Tuesday, it might decay a little bit more, let's say 20%. If it's on Wednesday, it can decay by 25%. Like that, depending upon how close it is to the expiry, the decay will happen in the premiums. But in just 1 hour of time frame in intraday, the decay will not be that much. The decay will either be 1% or 2% at max. The decay will be there due to theta. But in between that, if your delta, that means if the market is going in your intended direction, then you need not even worry about that small decay that happens 1% or 2%. The decay will not be that much. That too, especially for the at the money options. If you're taking out of the money options, then the decay might happen fastly. So that is why always we'll be looking for the at the money options only. And that too, like you are not carrying it forward, right? So if you're carrying forward, obviously the decay will be there. But intraday trading means mostly if it works out in your favor within few hours, like sometimes it can happen that within 30 minutes also you might get your target hit. Sometimes it happens that you need to wait for the end of the day for your target to be hit. So depending upon the market momentum and also how close it is to the expiry, the decay effect will be there. But most of the times you can ignore that particular small decay effect. And if you feel that the decay effect will be there, then if this is your support level, then if your ideal stop loss is, for example, let's say you're taking a call option, and when you're keeping at 40 as a stop loss, if you feel that almost 2 hours are completed and still the stop loss, till the target is not getting hit, in that cases, you can move your 40 stop loss to 38, because within 2 to 3 hours, the decay can happen. Little bit of a decay can happen. When the decay happens, when the decay happens, even if the Nifty is not going in the upward direction, your call option might slightly come down a bit because of that decay, because you're handling the trade for more than 2 hours or 3 hours like that. In that cases, you can slightly increase the stop loss by 5 points, like from 45, you can put it by 35. So that you will be having more range to cover that particular decay. That is when you're handling the trade for more than 3 hours and your stop loss is not getting hit and your target is also not getting hit. In that cases, you can do that. But in all other rest of the cases, you need not worry much about that premium decay that's going to happen in the intraday. No, never use monthly premiums, only use the weekly premiums, that too at the money only. Monthly premiums will not move, as like the delta of that premiums will be comparatively the weekly premiums will, weekly premium if you select, let's say 16,500 call option if you select weekly expiry, and same 16,500 call option if you select monthly expiry, for the cost itself as an option buyer, this will, let's say if it is trading around 100 rupees and if it's on the first week of that particular month, this could be trading around 400 rupees. Almost 3 times of the cost will be higher, plus this momentum. Let's say here you will get 1 lot, for example. Let's say you are having capital to risk for 4 lots. That means if on monthly, if you select, you might get only 1 lot. But if you select on the weekly expiry, you might get 3 lots or 4 lots you might get. Plus the move that is there over here, if the Nifty is going up, this will quickly move up in the intended direction, but this will not quickly move up because there is a more gap to that. It will slowly go up. Let's say if it is increasing by, for example, 10% increase we observed, this might increase by 8% or 7% increase only will be there. So if you calculate the absolute ROI based upon how much investment you made and how much return you got, it will always be better ROI you will be getting at weekly expiry as compared to the monthly expiry. And monthly expiries will be obviously costing higher. So it's better to go for the weekly expiry. And if you have more capital, go for more number of lots. But just because you have a higher capital, it doesn't mean that you will be going for the weekly expiry. Always you need to select in intraday, current week expiry you need to select. That too, if you're trading on, let's say if you're trading on Friday or Monday, on Tuesday and Wednesday, in all these 4 days, if you're trading intraday, you can select for the coming Thursday expiry, which means coming weekly expiry you can select. But when you're trading on Thursday, when you're trading on expiry day itself, select the upcoming Thursday expiry, weekly expiry. Don't select the same expiry day, because if you select the same expiry day, the premium decay due to theta will be higher, because the theta decay will happen more on the expiry day as compared to the rest of the days. That is why when you're trading on expiry day, select the next weekly expiry day, which is the next Thursday expiry day, but don't select on the same expiry day. That is one thing that you can keep a look at. Yep. So these are the things. If somebody is trading in Nifty and Bank Nifty, they can, anyways, like, because we have a concept for that as well. I thought I'll discuss that, but since you asked the queries, we have discussed now itself. So these are the 6 strategies out of the 11 strategies. Let me show you some of the recent examples and then ask you what is the kind of strategies that will be deployed. Okay, tell me, this one is very famous. It's a very good, simply continuous downward trending market. But okay, look at it and then find out of the 1 to 6 strategies that we discussed, what kind of a strategy could be applied at this particular thing on this particular day. Gap up and bearish. 5th entry, which is 5th is the gap up and bearish. Yeah. So what happens is, generally when the first candle is a doji candle, this is a doji candle. Doji candle means the body will be very, very less and wicks will be there on the both the directions. Wicks will be bigger. So when first candle itself is a doji candle, ignore this candle. Think it as not there. So completely ignore this. Then look for the second candle. Second candle is a bearish candle, then a pullback and continuation. So if you draw a line over here, you can see that this candle could be your entry candle. So gap up and bearish. So it broke the previous wick level and it is not having a very long bottom wick also. It's not a very big candle also. And if you enter here on this day, continuously the market was below 80 MA only, below 80 MA or 20 MA. So the trailing method could be possible. Let's take the recent examples. So we need to know also what is the support level. So if you see, this is the previous day high level. So if you see, this is the previous day high. Because on this particular day, this is the low level. On 21st, this is the previous day low. And this is the previous day high. We know that previous day high means generally, if the market opens in between here, this will act as a resistance level. But as I said, when the market opens with a gap up, this level will be treated as if it is broken, and this level can be considered as a support level. So if you see, even though, tell me what strategy can be applied over here. Out of the 1 to 6 strategies, what strategy can be applied over here? No, it's not gap up and continuation. Bullish, it's not bullish base violation. It's a bearish base violation. Bearish base violation, first candles will be bearish candle, bullish candles, if you can check. That is strategy number 6. So if you see the strategy number 6 that we discussed, so bearish base violation, what happens? It can form in either gap up market and gap down market. First candle will be bullish candle, then the bearish candles will come and take down the day's low. So that is called as a bearish base violation. So if you see here, the bearish base violation, that strategy got triggered. But I also mentioned one more thing that for example, this is where the strategy got triggered. So if you are going short, for example, here, where you will be keeping the stop loss. For example, assume that you are keeping the stop loss here, or generally some points you are keeping a stop loss. Ideally, somewhere over here you are keeping a stop loss. And look at 1:1. I said that minimum 1:1, we should not have any disturbance or any hurdle should not be there. But if you go short here, in between, what is there? There's a support level because this is a previous day high is generally a resistance. But once there's a gap up and once it got broken, this level can act as a support level. Since immediately before 1:1, we are having a support level. So even though our strategy got triggered, we will not be taking the trade because of this similar situation only. Otherwise, if you don't know that, you might think that, okay, that strategy got triggered, let me go and take a short trade. That will not work out. That is why you must be knowing the complete details of a particular strategy. It's not, that's why I said that if you just know the strategy, doesn't mean that it might work out for you. You might get a good results. You need to know completely when to execute that, when to avoid that particular thing. So this is why we should be avoiding that taking the trade of strategy number 6, because immediately below that there's a support zone. So we'll not be taking the trade here, even though the strategy number 6 got triggered. So that's how you need to look into the markets. And then what days you're saying? 15th July of Bank Nifty. So what happened with the 15th of July? Okay, so this one, can you tell me what is the strategy of this 15th of Bank Nifty, 15th of July? Same, bearish base violation only, just now what we discussed. Strategy number 6, there's a gap up and the bullish candle and the bearish candle. So here will be your entry candle. So here it is why. So if you see, it broke, this is, in this case, the previous day high is over here and previous day low is over here. So if you see, if I'm putting my entry here, if I keep the entry level over here, short position, and what I said, in these cases of a bearish base violation or a bullish base violation, generally the opening level will be a key level. So if this is the support level, once the support gets broken, I'll consider this level as a resistance level and I'll keep my stop loss few points above that particular resistance level. And for 1:1, I don't have any problem because my support level is over here. Till 1:1, if I don't have any hurdle, I can go ahead and then take that particular trade. So in these cases, I can go ahead and then take a short trade here. And then you need not even close the trade over here, because if the trend is continuously going down, you can use that moving average methodology, or you can use that swing high methodology like this, a swing high, one more swing high, one more swing high like that. If your stop loss is over here, you can trial it here. One more swing high it has formed, you can trial your stop loss till here. And then again, if there's a swing high formation, you can trial your stop loss like that. Using that methodology also, you can trial the stop loss. Or if the market is in a trending mode, you can use the moving average concepts also to trial the stop loss. But when we're talking about taking the trade, here you can take the trade because no, immediately below that, there is no immediate support level. It is there after 1:1. If it is there after 1:1, we don't have any problem. You can go ahead and then take the trade. See here, the entry candle will be over here. But after this, if you see, we need to know if there's a support level is there over here or not. Let's say if you enable. So why we should not be going short at 11 o'clock candle is, it is at a support zone. That is why we will, even though the price action says that, for example, you might say that without these institutional levels, you might think that if somebody has not taken a trade here, they might even enter a trade here or here, thinking that the price is going down. But that is why I said having the key levels on the charts is very, very important. In this case, what happened? The price took support from institutional level. So I'll definitely not go short at this candle because the price is at an institutional support zone. So price took support over here, and these levels will form at 9:15 itself. It doesn't change for the entire day. So when the price is at support level, we should never go short. But you can go short here because both the support levels are far away from the entry point. In that cases, I can even book my profit at the support level by way of 1:2 also could be possible. And here I will not initiate a new trade because it's at a support level. So like that, all the key levels when you enable now in the market, you will get to know why we are not taking trades, even though as per price action, it looks very exciting for us to go short here. But what if you have zones on your chart? You will definitely not take up that wrong trade. So that's how these zones also will help you to not take up the wrong trades. So let's continue further. Okay, strategy number 6 got completed. Now let's go over the strategy number 7. Strategy number 7 is based upon the virgin CPR concept. In virgin CPR concept, it's a reversal strategy. It is not a continuation strategy. It's a reversal strategy. So in this case, what we will do, we know the concept of a virgin CPR. As to the CPR will be there. And if the CPR does not touch on any particular day, we will extend that range for the upcoming day. And this will be VCPR for the today on the day 7 session. And how the VCPR will work? VCPR will work as a good level of a support or a resistance. In this case, the price is coming from the top side to the bottom side. That means its level can act as a support level. So how to find out whether this is acting as a good level of a support or not? There will be two conditions will be there. Condition number 1 is you will see a bottom wicks. Candlestick color could be anything, but the bottom wicks will be there. Whenever there is a bottom wick, which is an indication of a bullish pressure. That too, if it is happening at a virgin CPR, we can say that there could be some kind of a buying pressure that is coming. That is one indication. Second indication is a momentum candle will break out of the CPR zone like this candle. A momentum candle will break out of that CPR zone, that too bullish momentum candle, because we're looking for a reversal trading opportunity. When the market is coming down, it has to reverse from this level, means we need to look for a bullish candle. And that too, if it engulfs the previous candle, that's even better. But even if it is not engulfing also, if it's a bullish momentum candle, if it is forming, then you may go long around this candle by keeping the stop loss below the wicks. Whatever the previous wicks levels are there, you can keep your stop loss below that previous wick level. And then you can initiate a reversal trading opportunity in this case. So this is the virgin CPR strategy reversal. This can also be applied in case of downward market. That means in case of a short entry opportunity also, you can look at this. For example, let's say the market has opened here. And if it is coming up like this, and you may see that a wicks on the top side. When you're looking for a short entry, you need to focus on the top rejections. I mean, wicks will be on the top side. And if you see a bearish momentum candle coming out of that virgin CPR zone, then you can look for a short entry opportunity here by keeping the stop loss above the previous wick levels. That's a reversal trading opportunity. Here, waiting for the retest or not, generally retest might not generally happen. Most of the times what happens now, the price will continuously go up like this. In that cases, you might miss out on a trading opportunity. But in case of a reversal patterns, generally the stop loss will be lesser because you are just taking the trade when it is about to reverse. So in case of reversal trading opportunity, since the stop loss is lesser, there could be possibility that even if it is hitting your stop loss, you might not be losing so much. You will be losing enough amount, less amount only, because the stop loss range will be lower. But if you wait for the retest, most of the times you might not get a trading opportunity, might be missed out. That means not every time the price will break like this and do a retest. And then if it is continuing, not many times you might get an entry opportunity over there, where that is one of the downside if you wait for the retest in this particular strategy. Yeah, so virgin CPR reversal strategy means on any particular day, if the price is not touching the CPR, you will extend that particular range for the next day. That's a virgin CPR that we explained already. Then next day, we need to check if the price is opening above, and then if it is touching here, the moment it is touching the virgin CPR, if you observe long bottom wicks, and then a bullish momentum candle coming out of the CPR zone, then it could be possible that the reversal can happen. At the same time, if the price opened here on the downward direction, and then if it is coming up like this, and if there is a long top wick, let's say bearish momentum candle coming out of the CPR zone, that could indicate a reversal is going to happen, because we know that this level is already a key level. So when this happens, you can look for a reversal trading opportunity. In this case, you can look for a long entry opportunity. In this case, you can look for a short entry opportunity. And keeping the stop loss, if you're going long, you'll be keeping the stop loss few points below the previous wick levels. If you're going short, you'll be keeping the stop loss few points above the previous wick levels. Yeah, CPR will obviously can be added as a confidence over here, but see what happens if you here the price action analysis is the wicks plus the candlestick. I mean, all the candlestick analysis we are using as a price action analysis along with the CPR zone. But some people might even say that the price made a gap down, pull back and continuation. So this, if you're going short here, it looks as if it's a proper price action pattern where it broke the previous swing low level and then formed a momentum candle. So what if I go short here? So you may also think that if you are not using the CPR, you may go short here thinking that the price can go short. Maybe you will get some momentum could be there, but after that price got reversed. That is because there is an immediate support level just below this level that is called as the virgin CPR. So along with price action, if you know the key levels in intraday, then you will be your profitability or your success ratio will improve. But if you are not using any level, just based upon some small lines, etc., if you're doing, then maybe it could be possible that even though you're following the price action technique, the results might not come out well. No, nothing is necessary here. See, never assume that anything will be a compulsion that has to happen in the trading. So there is no necessity that the price has to reverse 100%. It is an assumption that virgin CPR will act as, just like how we take the assumption of CPR will act as a good level of a support and resistance. Just like that, virgin CPR is also assumed as taking a support or resistance. But just because we took an assumption doesn't mean that, let's say here, if there is a small bullish candle that is forming, doesn't mean we will go ahead and then take a long trade here itself. We know that there's an assumption, but to confirm that assumption, we need to have some data. Price action data is required. The price action data tells that bottom wicks is one price action data and momentum candle coming out of the CPR zone is second price action data. So we have an assumption. Now we have a confirmation. So now we have an assumption plus confirmation of a price action. Then we can try to take the trade that to a reversal trading opportunity here. So it doesn't mean that it can happen that price can easily break this level and then go down also. In that case, what you will do, your assumption will go wrong and you will not take the trade. That's it. But there is no rule that 100% it has to reverse from virgin CPR level. So like that. So the next one is, so this also is one more example. So here if you see, this is a virgin CPR and we can extend the CPR range for the upcoming day. And you can check that the initial candle, and this is the initial, this is a CPR for that particular day. So you can see a rejection from the CPR, a very big bearish candle coming. And the bottom wick we can see for the first candle. Second candle also we can check the bottom wick. Then you can see the momentum candle coming out of the CPR zone. And here, if you wait for the retest might not happen. Continuously it was going down. Retest means the price has to come down to this level and then continue. So if you're waiting for the retest, it might not happen all the time. So here you will be going long by keeping the stop loss over here, because when you are actually finding the good reversal trading opportunities, the stop loss points will be lesser. So when the stop loss points are lesser, obviously your risk will be lesser. So good risk reward trade also can be found out in case of a reversal trading opportunities as well. So here again, for the next level of it, this was a CPR for the current day. CPR, it was acting as a resistance level, but since it is a narrow CPR, it could be possible that it can break easily. So it broke that level. And again, once the resistance level is getting broken, we can check that it was acting as a good level of a support. So that's how the normal CPR also, once it is broken, that support resistance will turn into support just like the any other level, because CPR is nothing but what? A support or a resistance level. So that also once broken might act as a resistance level. Even in this case also, this is a virgin CPR is acting as a support level. If let's say the support is getting broken, then the same level will act as a resistance level also. It doesn't matter if it is a CPR or institutional zones or anything. The moment any support is broken, it can act as a resistance and vice versa. So that is strategy number 7. Now strategy number 8. It's a CPR continuation break. Now this is also based upon the CPR only, but it's a continuation pattern. It's not a reversal pattern. So how to find this out means, so here we need to check CPR continuation break. It will be generally mostly be used in case of a narrow CPR instead of a wide CPR. So how we need to use this is, the price has to open on the one side of the CPR. That is the condition number 1. And condition number 2 is, when it is touching that CPR, it has to react. That means now in this case, when the price is opened above the CPR and when it is touching down, it will generally has to act as a support level. So that reaction we can observe here. Price was acting as a support level. And once the price was acting as a support level, then it should not change the trend. Trend means what? Now it's a downtrend. Downtrend, if it has to change into the uptrend, then it has to break this level and then it has to change the trend to the uptrend. But the trend has to be intact. That means it has started from the downward direction. It made a pullback, but it did not change the trend completely. It is still in a downtrend only. It came down. Again a support. Now we need to wait for the price to break this CPR completely, and complete full candle. Complete candle has to even the beginning and ending. Complete candle, body of the candle has to come out of that particular CPR zone. And this has to be also a momentum candle. And it should not have a long bottom wick. Plus it should not be a very big candle. All the conditions has to be satisfied. But one more extra condition is, complete candle has to come out of that particular CPR zone. Then we may look for short entry opportunities over here. And sometimes we can also wait for pullback and continuation. That means instead of going short at this candle, we can also wait for a pullback. And then if you see, this can be considered as a small pullback and continuation candle. This is also a pullback and continuation candle. But sometimes it can happen that continuously a bear candles will get formed once it is breaking. So it can happen that if you wait for a pullback, maybe your entry will be a little bit later. But if you generally enter around this candle, you may get an early entry opportunity. So that is one thing that you can check out. If this reference chart is in live trade, I would suggest to close my trade in CPR range. How to overcome that? Which one you're talking about? Previous one. Okay, so this one, right? So in this case, what can happen is, if you take a trade here, let's say if you're going long here and if you're keeping a stop loss, obviously we don't know that this is all will happen. We don't know. So we only have this data. And then the moment price touches the CPR zone over here, now we can see a bearish candles coming in, right? And then bearish candles are coming. Now, generally how the market in general works is, price might not continuously go up like that. Price will go up, make a pullback and go up and make a pullback and go up. So the reason how you can tackle this situation is, if you have a swing high levels, this is a swing high, you need to check that when the price is reversing from the CPR zone, check for the swing high level. What is my previous swing high level? If the price is even making a pullback or resistance at a CPR, but if it is not breaking your swing high level, then there is no need for you to close the trade. You can continue the trade further. So you can it can come back and it can break out and then go in your direction. But if it is breaking the previous swing high level, then you can exit better, because it can also happen that from here, that current day CPR could be a good level of a resistance zone, and price can even come down like this also. We don't know that around this point, we don't know whether it will reverse or it will continue like that. So the thing is, instead of exiting just by looking at a bearish candle, if you exit, you might miss out on a good trading opportunity over here. So try to figure out what is your previous swing high level. In this case, the swing high level is not exactly proper. Maybe we can consider this pullback as a swing high level, but it's not exactly proper because it's not a bearish candle. But as per my experience, I'll consider this as a pullback because it's going up, made a pullback, then continued further. So I'll mark this level as a swing high level. If I see a candle closure, I'll wait for the candle to close below this swing high level. If there's a candle closure, I might exit. But if the candle is not getting closed below this level, then I might not exit. I might continue the trade. I'll still be in the trade, not a problem. So that is one hack where you can know whether to exit the trade or whether to continue it further. So that is one thing. Yeah, coming back to this trade, this is a continuation pattern. Strategy number 8. CPR will open one direction. I will take a minor support or resistance depending upon where it is opening. That means it is reacting. We must know that it is reacting, but it should not change the trend. Let's say if it is opened here and if it is taking a resistance, it should not change the trend completely. It can take a resistance, but still it has to be in a bullish mode only. Then if it breaks the candle completely and a complete candle should be out of that CPR zone, then we may look for a long entry opportunities. In these cases, you can look for a short entry opportunities. But in this case, it's very, very important to know that to focus upon any immediate levels. That means we are already using that for every strategy. But in these cases, completely, it's very important that when you're taking this kind of a breakout trade, make sure immediately there is no immediate support zone or immediate resistance zone should never be there. Because most of the times whenever the CPR breakout happens, immediately below there could be previous day low or above there could be previous day high. Some levels could be there. If immediately you find that levels, don't take up that particular trade. You need to wait for that level also to get broken for you to take the trade. This one. And strategy number 9 is based upon the institutional zones. So as I mentioned, institutional zones are intraday supply and demand levels. So it can happen that the price can reverse or price can break and continue further. So in this case, we're talking about institutional zones continuation pattern. This is a continuation strategy, strategy number 9. So what happens here is, until now, whatever we discussed, I mentioned that you can take the trade at the breakouts, right? But only for this strategy, which is strategy number 9, don't take the breakout trade. Wait for either a retest or a pullback. Specifically at institutional zones, do not try to take the breakout trades even if the breakout candle is a proper momentum candle and even if there is no long wick, etc. Even if every condition gets satisfied, don't enter the breakout trade. Wait for either a retest or a pullback. So what is the retest and what's the pullback means? So in this example, if you see, there's a price. This is a support level, institutional support level. Price opened here. The resistance level will be somewhere over here. But the price came down. But here itself, we have some other gap. This bearish base violation strategy got executed here itself. But let's assume that the strategy is not there. And even we are looking for a strategy number 9. So in this case, price made a small breakout. And then we can see there's a pullback happened. Then after the pullback, we need to mark this level. This level we need to mark. Now here we need to wait for the proper breakout candle. After a pullback also, we need to wait for the proper breakout candle. So here after pullback, this candle could not break properly because it's not a good momentum candle, which is having the good body below that particular level. This candle also could not. This is a bullish candle, so obviously we will not be trading it. But this candle, if you see, at this candle, this is the previous wick level. So this candle is a good momentum candle. It's breaking the previous wick level, plus 50% of the body is below that particular level, and retest is also done. So this is where you can look for a short trading opportunity. But it can happen that sometimes the price will not make the retest. That means price will break down like this, and it might not come back to this level. That is, the price will not retest. Price will break, but it will make a pullback and continue further. If it makes a pullback and continues further, then again wait for the momentum candle to break, and then you can go short here. But you need not wait for the retest to happen all the time. Retest may happen, may not happen, but pullback will definitely happen, because if you see, there's a pullback here, continuation, there's a pullback and continuation. So pullback and continuation, pullback, and here there's a continuation. That means pullback will definitely happen in any market. But retest, whether it will happen or not, we cannot say. That we need to wait and watch. So if the retest happens, you'll wait for the retest. If the retest is not happening, at least wait for the pullback and continuation. Anything is fine. But don't enter at the breakout trades, because that might not give you good results. It can result in a fake out also. So to avoid that fake outs, don't enter at the breakout candles. That is a strategy number 9. And this example we already discussed. We should be avoiding the false breakouts. Why there is a false breakout? Because this breakout candle is a not proper candle, and this candle could not break the previous wick. This candle also could not break the previous wick. So since because there is no proper candle here, we will not be taking the long trade. Even though you may say that the price broke, retest and continuation happened, but that retest and continuation, when it's happening, it has to break the previous wick properly. If it is not happening, then we will not be taking the trade. So you need to combine the things. It's just when you are using strategy number 9, you must not just see the candle coming out of the zone and then try to, you may think that, okay, the breakout, pullback and continuation, let me go long here. You should not be going long because it's not breaking the previous wick. So all the conditions has to be followed properly. If you are missing anything, then you might enter into a low probability trade setups, and probability is high that stop loss might get hit. And strategy number 10, which is also a very good popular strategy. Now, institutional zones, all these strategies will be used only for the 5 minutes time frame only, not for the higher time frames, because since it is specifically for intraday masterclass, I'll be discussing only about the intraday strategies only. So here you will be applying all in 5 minutes time frame, not in a higher time frame. And this one is a reversal strategy. Reversal strategy, how you will be working is institutional zones will be there and the zones will be broken, but it will not continue further because it could either be a false breakout or it could be a real breakout, but the price got reversed. Anything can happen. So reversal means just because the price breaks this level doesn't mean that for the entire day it has to continuously go up like that. Suddenly the markets can reverse at any point of time depending upon the news or any situations. Markets can reverse. That is obviously not in our hands. But we can try to find out a reversal opportunity when there is a fake breakout. For example, tell me if there is any proper breakout here or it is not a proper breakout. Can you see this candle or this candle, this candle? Is there any proper breakout or not? Let me know. Only this circled part. Can you observe any proper breakout over there? Okay, let's understand if there's a proper breakout or not. The first candle high is this level. So what I'll do, I'll obviously wait for the candle to close, a good candle, momentum candle to close above that level. Now, this is a good momentum candle, no doubt about it. But the problem over here is, if let's say if this wick is not there, then I might consider this as a proper breakout candle only. But now this wick is there. That means now we need to wait for that proper candle, momentum candle to close above this particular wick. So what we will be doing now, this is not a proper candle, momentum candle. We cannot consider because the 50% of the body is not above that particular level. Then if you see after some time, it has formed a new wick. Now I'll be waiting for the candle to break this wick. That is why this momentum candle also could not break this wick properly. Then what we'll do, we'll wait for some more time, but there is one more wick you can observe. So now what I'll do, I'll be waiting for a momentum candle breaking that previous wick, but that could not happen. There's a bearish candle, and price was going in the downward direction. That means actually, even if you properly figure out the proper breakout opportunity, there is no breakout opportunity that says that you go long. Then obviously you will not be going and taking a long trade over there. Then what you will do, you will be looking for whether the price is after the retest. Now let's say there's a breakout, there's a retest, whether the retest is successful or not. If you see the retest, the price is taking support, and if the price is getting a momentum candle like this, then the retest is successful. You can apply strategy number 9, which is the breakout, retest and continuation. You can go long, but the retest is not successful. The price made a retest, but it could not continue further. It broke that level and came down. Now we can consider this as a fake out, or we can consider this as a reversal. But just because there's a breakout that happened immediately doesn't mean immediately we might go short. We need to have one more confirmation. That confirmation, I already said, one thing is you need to wait for the previous swing low to break. So if you see, before breaking the candle, before candle breaking the institutional level, whenever you see any swing low means whenever there is a pullback, you need to mark that level. If the price breaks that pullback level properly, this candle break the pullback level properly. Plus, why this candle is because here we can already see that momentum coming down. Plus, this previously it was a support level. Now, once the support level is broken, you can observe that this level was acting as a resistance level. So we have multiple confirmations to think that the price has changed the trend and now it is coming in the downward direction. So when we have multiple confirmations like that, we can wait for the candle to close below this level. Even if this candle is little bit like momentum, not that momentum candle. So we might ignore this small candle. But after that, if it is breaking this previous wick level, then you can look for a short entry opportunity over here. So that is called as a reversal trading opportunity. This can happen both in case of a price breaking in the upward direction and then getting reversed, or price can break in the downward direction also, and then also it can get reversed like that. So that also you'll be looking for a previous swing high level. And whenever there is a candle which is breaking the previous swing high level, you can look for a long entry opportunity because it's a reversal pattern and you can look for both. Price can break in the top side and also reverse, or price can break on the bottom side and also can reverse. So you can make good use of these fake breakouts by taking the reversal trading opportunities. So that is one thing. And sometimes it can happen that price will do a very good breakout and you might even take a trade thinking that the price make a very good breakout. Even though, as I said, anything, the trades that you're taking, you applied strategy number 9 and it went up, but suddenly it came down and your stop loss got hit. Because it doesn't mean that every strategy will work 100% of the time. It can happen that some might not work out. And then your stop loss got hit and then you exited. But then you saw this strategy number 10 going to happen. Then you can take a further trade by looking at this reversal strategy. So don't think that just because one stop loss got hit doesn't mean that you need to stay away from that particular instrument or not. Immediately, particularly whenever this happens, when you apply strategy number 9 and got a stop loss hit, then look for strategy number 10. This might work out. So like that, this is a reversal trading opportunity that can be applied. And in this case also, you can see there is a reverse, the institutional resistance zone, small pullback and a breakout candle. Breakout candle, everything is proper. It's a good momentum candle and 50% of the body is above that. Everything is fine. But the only problem is the candle size is not that good for me. Generally, even if there is this much of a candle size, I'll not enter. That is first condition. Second condition is, that whenever I'm talking about institutional zones breakout strategy number 9, I'm always asking you to wait for a retest or a pullback. Don't enter at a breakout trades. So that is the reason I will not be interested to take the entry at this candle. I'll be waiting for a pullback and continuation. So if you see there is a pullback and the wick level, it has to break this level. Without breaking that, there's one more wick that has formed. So there's a one more wick that has formed. There's a one more wick that has formed. That means every time the wick is forming, there is no single momentum candle which is closing above that particular wick level. It's always some resistance is there, previous wick is there, previous wick is there. That proper momentum candle could not be closed. So obviously I'll not enter at this candle or even at this candle or any candle. I'll not be taking a long trade by using strategy number 9 because that's not a proper breakout. Even if there's a breakout, I'll be waiting for the price to retest and continue or a pullback and continue. Here the pullback is also not working out properly. So I'll not be taking a long trade here. Then even though strategy number 9 is not working, then maybe I'll look for if the price is retesting. If the retest is successful, if it is coming back like this and then breaking this level, then again I can deploy the strategy number 9 here. But if the retest is unsuccessful, then look for the strategy number 10, which is a reversal trading. That means you will be marking the swing low level like this. And whenever the price is breaking, momentum candle is breaking that level, then you can go short here. And generally, when in case of a reversal trading opportunities, the immediate next level of a support or resistance, depending upon how the market is. So in this case, you can see that the price was acting as a support level. Previous day high was acting as a support level. That means when the price is coming back also, this level can act as a support level. And here, if you see, when you mark the swing high, so if let's say this is a previous swing high, the price, whenever it is breaking that level and then coming upside, that means we can say that, okay, this level is acting as a strong support level. Let me exit at this point. I'll not carry forward. But just because the moment you see bullish candle doesn't mean that you need to exit the trade. Here is your entry. Just because you saw a bullish candle doesn't mean you immediately exit it, because it can be a small pullback and it can also continue further. You don't know what's going to happen. So for that only, try to find out what is your previous swing high And then if the candle is closing above that swing high, then you can exit. If it is just making a bull candle and then continuing further, you can still continue like you are 1:2 or 1:3. You can, depending upon how good you are getting the momentum, you can continue the trade. But just because one candle, bullish candle is coming, doesn't mean that you need not close the trade. But before this happening, if you got 1:2, then you may even exit that. You need not wait for more 1:3 or 1:4, because this is a reversal trading opportunity. And reversal trading opportunity means what? Market is not trending. Trending means continuation will be there. You will be finding a continuation patterns. Reversal means the price is clearly not a trending market. It is a range bound or a volatile market. In that cases, even if you get 1:2 trades, that's a good enough. You can even close at that particular point also. So that is called strategy number 10. Now strategy number 11, this is the last intraday strategy. Now strategy number 10 is based upon the moving average. So we know that moving averages of 20 and 8, etc. But what is the importance of 50 SMA? Now 50 SMA candle, 50 SMA moving average. These are the three conditions that needs to get satisfied. And obviously the fourth condition is that that's common for every strategy. You need not discuss specifically. But what are the three conditions that we need to get satisfied? Condition number 1 is, in case if you are looking for a long entry opportunity, then the bull candle has to break this and then go upside. If you are looking for a short entry opportunities, then the bearish candle has to break the 50 moving average. So in this case, the price is clearly coming from top side to the bottom side. So we'll be generally looking for a short entry opportunity only. But condition number 1 is a bearish candle has to break that 50 SMA. So here the condition number 1 got satisfied. Condition number 2 is both 8 moving average and 20 moving average EMA has to cross the 50 moving average. That happened around this point. 20 got crossover, and exactly at this point, 8 got crossover here itself, but we need to wait for both 20 also should crossover. So the 20 moving average did a crossover over here. So here the second condition got satisfied. Third and most important condition is it is the continuation candle. That means since it's breaking on the downward direction, we need to wait for the downward bearish continuation candle that has to break the previous low in case of a short trades. That means basically nothing but you need to wait for the previous week level. And if the price breaks that, that means nothing but you need to wait for a proper breakout candle. And if you get a proper breakout candle, you can look for short trading opportunities. But make sure that immediately just below this level, there is no immediate support level. So that's the only thing. This is the strategy number 11, which is based upon the moving average. Now this can happen in the upward market also. That means there could be, let's say like that, 50 SMA could be there, and there could be a bullish candle, it will break out, and both moving average could cross over. And let's say if there is a wick over here, the price bullish candle can form like this. So here could be a long entry opportunity. So both crossovers can happen on the downward direction as well, plus on the upward direction also, the crossovers can happen. And this is only for intraday. Don't carry it forward for the next coming day and all. It has to, the crossover has to happen on that particular intraday only. So with this, we have this kind of a strategies also can be there, where this is also a crossover only, but it's a low probable crossover. You should not be taking the trade here, because here condition number 1 and 2 will get satisfied, but condition number 3 will not get satisfied. So you can check this also, the price is coming down and the candle closure below 50 SMA. Condition number 1 got satisfied here, and here the moving average both 20 and 8 got crossover. Condition number 2 got satisfied. But what we need to do, the continuation candle has to break the previous swing low, previous low. So this is a low candle. The candle could not break this level, and before breaking, there is one more wick that has formed. So if you see for the entire day, there is no single candle which is breaking that key level. So obviously we will not be looking for a short entry opportunity. And we can also see that it's not a clear downward moving market. So that's why the condition number 3 is very crucial. You need to wait for the proper breakout candle, then only you will be taking the trade. Otherwise, don't take the trade. This kind of a low probable crossovers will be happening whenever the market is in a range bound or whenever the market is in a sideways. So obviously you'll be avoiding those kind of a low probable crossover strategies. So with this, the 11 strategies are completed. Now to extend this little bit, you need to know when to avoid the trades, especially if you're trading in intraday as a equity option. If you're trading in stocks, etc., then obviously you will be looking for either buying and selling, and you will require some momentum to happen. If the market is not getting a momentum, you will not be able to get the profit or targets will not get hit. At the same time, if you're an option buyer in intraday, you need to, if you're a call option buyer, you need to have market move in the upward direction. If you're a put option buyer, you will want the market to move in your downward direction. But when the market is in a range bound condition, then as an option buyer, it's not advisable to take the trades. In that cases, how to avoid it, how to even identify the range bound market is, one of the simplest way to find out is the moving averages are in the sideways, or the moving averages will be overlapping with each other. That means if you see, I'll enable all the three moving averages. The moving averages are not either going up like this or not coming down like that, but they are moving in the sideways. They are overlapping with each other like this. Overlapping means this is what? One will touch each other and then move in the sideways. Here there's a touching, overlapping, overlap, overlap. It is not, the gap is not there. If you observe, there's not a very good gap between all the moving averages. It is continuously the gap should form. Then we can say that it is trending. But we can clearly see that overlappings are happening and it is in the sideways. That is the simplest way to find out whether the market is sideways or not. Then there is one more thing which we already know. When the market is inside the CPR, when the market is stuck inside the CPR, then also we will not be interested to take the trade, because that's also an indication of a range bound market. So here you can see on the top side, we have previous day high level. On the bottom side, we have previous day low level. And there is one more condition I said, that there is a day high and day low level that we need to mark whenever the price, okay, in this case, for example, let's say the price went up and this is a resistance level, because previous day high is acting as a resistance level. In between, we have a CPR. So whenever the candles are inside the CPR, we don't take up the trades. If we want to trade the CPR, let's say, if you want to deploy the strategy number 8, which is CPR coming out of the, candles coming out of the CPR, then what is the condition we mentioned? A complete candle should come out of the CPR, but that could not happen here, because you can see that only the part of the candles came out of the CPR and only the part of the candle came out of the CPR. That too, we can clearly see that day low level. Whenever the first candle is a very big candle like this, mark both the day high of the candle and day low of the candle. That means the high of the candle and low of the candle has to be marked. Whenever the candle is, first candle itself is a very big candle, means you need to mark the high and low of that particular candle, because those levels itself will act as a resistance level and support levels. And you can clearly see that inside there is a CPR, top side there is a resistance, bottom side there is a support. So obviously there is no trade opportunity you will be taking on this particular day as an option buyer. But for the option sellers, generally the sideways markets are good, but option buyers, it is not good. And the final thing is, when to avoid the trading is, sometimes you will see a volatile market. Volatile market indication is sudden big candles and sudden small candles, if you see, and the price is not going in any one particular direction, that is an indication of a volatile market. So in volatile markets, you can see sudden big candles and small candles, sudden big candles and small candles, and both sides. And the bull side also it can happen, on the bear side also it can happen. So sudden big candles and small candles. In this case also, you can clearly see that there's also one more thing that I mentioned. The price will open and it will go up. It will come back to the opening level, it will go down, and it will come back to the opening level. So in these scenarios, I mentioned to mark the day high level and day low level. So if you see, the day high level was acting as a resistance level and the day low level was acting as a support level. So for the entire day, the price could not even break the day high and day low, which is also an indication of a sideways market. So here also, as an option buyer, we will not be taking up any particular trades. So that is the concept. Yeah, 1 minute scalping strategies are still there, so that we're going to cover now. Yeah, before that, stock selection, there is one concept that we introduced from this particular batch is the stock selection, because this was not actually a part of this particular thing, because this, as mentioned, only the strategies are going to get covered. But we thought of introducing some stock selection methods. Generally, like stock selection methods, there are many n number of scanners and n number of things that are available. If you generally find out a top gainers or top losers, or even if you find out if you have a list of stocks, and let's say Nifty 200 or Nifty 100, etc., around 10 o'clock or around 11 o'clock, even if you filter that particular stocks, let's say if the Nifty and Bank Nifty is in green, then filter with the top gainers for Nifty 200 or Nifty 100 and check for the stocks which are up by 1.5 percentage to 2.5 percentage upside. If it's already up by 1.5 percentage or 2 percentage up by around 10:30 or 11 o'clock, then you can look for long entry opportunities in those particular stocks. You can keep a watch of those stocks and then look for long entry opportunities using the 11 strategies that we discussed. If the, let's say, Nifty or Bank Nifty is bearish, that means if the Nifty Bank Nifty is in red, then filter by top losers from that Nifty 200 or Nifty 100, whatever the watches that you have. You can filter by the top losers and check for the stocks which are down by 1.5 percentage to minus 2.5 percentage. And then there could be 10 stocks or 15 stocks like that. Selecting those stocks, look for the short entry opportunities. So out of the 11 strategies, we have around 5 strategies which are for long, which are for short, remaining which are for short, etc. Some strategies can be applied for both long and short. So like that, look for those kind of strategies that you can apply. And if it's a trending market, you can use the moving average technique. If it's a sideways market, you might not use that moving average technique. That is one of the simplest ways, because if you go for stock scanners, there are more than hundreds and like even 500 stock scanners are there in different websites. Obviously, you might not have that much of a time to screen each and everything. So this is the best way to find out, because you will be having a limited time. Within that limited time, you might not scan all the stocks. So that is one simplest way to do that. Secondly, so using that concept, since you will be having an access to the institutional zones, you can look for strategy number 9 and strategy number 10 using this methodology. The same thing only. That is, you will be filtering out the stocks. If the Nifty is bullish, you will be filtering out the stocks which are up by 1.5 to 3 percentage, for example, around 11 o'clock or around 10:30, and look for the stocks which are getting a constant support from the moving averages, like 8 moving average or 20 moving average. Because if the market isn't trending, then only you'll be getting a support from 8 and 20 moving average. Then if there's a breakout and continuation, what strategy you'll apply? You'll be applying strategy number 9. Let's say strategy number 9, there's a breakout, but the breakout is not a proper breakout. And if it is reversing, then you'll go for strategy number 10. So that same thing only, but only for strategy number 9 and 10 can be applied using this methodology. And there's one more concept called long build-up and short build-up. So long build-up means generally the price will be rising, plus the open interest of futures also will be rising. That indicates that there could be a potential upward momentum in these stocks. Short build-up means the price will be falling, plus open interest will be rising in futures. That is generally an indication that many futures traders are taking a short positions. So that means that there could be a possibility that there could be some kind of a downward move that can happen. So this also, using this particular link, you can check out around 11 o'clock or 10:30. You will be getting to know what are the stocks which are in short build-up. So you can look for short entry opportunities. If there are stocks which are in long build-up, you can look for long entry opportunities. But look at the Nifty. If the Nifty is in green, then look for long build-up only. If the Nifty is in red, then look for short build-up only. Like that, you can filter, and then so that you are in sync with the market. Then this is also from the trendline.com. So here also the active stocks based upon the futures and options can be found out here. So using this, whenever the futures and options stocks are having good activeness, then that will also give you some good momentum can be happening. And this will keep changing depending upon the time where you are checking. So this also you can check out to see what are the stocks which are having good momentum. This is based upon futures. So here the price gainers and open interest gainers. This open interest is the futures open interest, and price losers and the open interest losers. But if the Nifty is in green, focus upon the gainers. If the Nifty is in red, focus upon the losers. So what are the active stocks which are trading in futures? That will be told here. So that for the options also, it is there, same like this. And these are available for free. You can check this link and then you'll be getting to know these things. So most active by contracts, call options when it is in green. So put options over here. So like this, depending upon this, you will get to know what are the stocks basically, the name of the stocks which are having some momentum. When there is a momentum, even though out of all these stocks, even if you select one particular stock and made a 1:2 trade, and then when you risk 2% of your capital, and when you capture 1:2, which means you're capturing 4% in one day. That is even more than enough, because 4% in one particular day means that is more than enough. So don't think that you need to focus upon too many stocks and all. Even focus upon some particular quality stocks, but your strategy application should be proper. Like for stock selection, there could be multiple ways. But the thing is, no matter even if you select the stock, you need to be able to use that properly. Just because somebody told some stock doesn't mean that you might not be able to trade that if you don't have a proper strategy. So first you need to focus upon the strategy, then stocks selection can come from anywhere. So like this. Now we'll discuss about the scalping techniques, which is a 1 minute time frame technique. So 1 minute time frame technique, there's a caution for this particular thing. The caution is so everything, there's nothing in 15 minutes. Whatever we're discussing, everything is in 5 minutes only. So coming to the scalping techniques, here it is a 1 minute time frame because the name scalping means which is very, very lower time frame. So the lowest time frame that we can go for is 1 minute time frame. And here the caution is it might not be for everybody because it requires very fast execution. And if you're little bit slow in executing or keeping the stop losses, or even if your broker platform is taking some delay like 10 seconds or 20 seconds, then also this might not work out. Because for this, like let's say if you are getting a strategy opportunity, you need to enter immediately. You can't even delay for 30 seconds also. 30 seconds delay also, your strategy might not work out in your favor. So this you need to test rigorously, that too if you're a very active trader looking at the markets, and if you can like enter and exit at very sharply within 30 seconds, then only these scalping strategies are for you. If you are not that, then not a problem. You can stick to the intraday strategies only. And these scalping techniques could be a little bit different as compared to the intraday strategies. We need to have a proper focus to understand this. So there are two scalping techniques. One is based upon the 1 minute candle strategy, which is the opening candle strategy. So what is the opening candle strategy is, you can apply this strategy only if the first two 1 minute candles range. That means two 1 minute candles will form, right? Within 2 minutes of market opening, two 1 minute candles will form. You need to mark a range on the top side and on the bottom side for the entire two candles. Then either third candle or fourth or fifth, either of these three candles has to break this range properly. Properly means again the same breakout concepts will be applying. Then if it is breaking that range, on the top side you'll go for long by putting the stop loss as 1:1. Like target is risk reward is 1:1. And just below the entry candle, you'll be keeping the stop loss. Just below means like 5 points below the entry candle, you'll be keeping the stop loss. In case of Nifty. In case of Bank Nifty, 10 points below the entry candle, you can keep the stop loss. Now this can be applied only in Nifty and Bank Nifty. That means this cannot be applied for any of these stocks, no matter if it's F&O category, non-F&O category. You will not be applying this. Only in the Nifty and Bank Nifty only you'll be applying. The main thing is for scalping, we need to have very high volume should be there. Plus, this is a only first 1 minute candle strategy. That means you cannot have that much of a time in just 5 minutes to look into multiple stocks also. So you can look only at Nifty and Bank Nifty. And within the first 5 minutes, you will get to know whether there is a trade opportunity is there or not. Within 5 minutes, if there is no trade opportunity, you will not be taking the trade, because this is only for the first 5 minutes, 1 minute candle only you will be getting to know whether there's a strategy opportunity is there or not. For example, you can check this. This is a 1 minute time frame. Now Bank Nifty 1 minute time frame. This is the first candle. This is the second candle. You will be marking a level over there, top level and bottom level. You can check that the third candle itself broke that level properly. The moment you need to wait, that means you need to wait for that 1 minute candle to close. Only when it closes, immediately within 10 seconds or within 5 seconds, the moment it closes, no, you need to take an entry. That means what? Let's say if the price is trading around 35,800, for example, or 35,820, for example, then even before the closing, you need to add both 35,800 call option and 35,800 put option. You need to add it and keep it ready so that the moment if it breaks, now it is breaking in the upward direction, right? So let's say around 30 seconds is left for the candle to close. Before that itself, you need to open the 35,800 call option and you need to find out how many lots you are going to purchase. Just that the moment if it closes over here, immediately you need to punch in the order. And within 10 to 15 seconds, you need to also place the stop loss order also. That much fast you need to behave in this. If you're making any delay, then don't do in the scalping technique. You need to stick to the intraday only. Basket order, if it is working, then you can do, but to like find out the levels now, if you are looking at the chart and then finding out and updating the basket order, it will take some time. Before that, the price levels will again move upside. So it might not, because in market order, you need to put the both stop loss and then target level positions and all that. But don't put or use the basket order for this particular thing. Just execute at the money. Execute the moment it's here. Just click on buy position so that it will get executed. Then what you will do, you will be going to the options chart. That I'll tell you how to do that, how to keep the stop loss in options. So using that methodology, you can place the stop loss order separately. So use that instead of using the basket order. So here what you will do, when you keep 1:1 target, there will be two options for you to book the profit. One thing is, the moment you get 1:1, you can book the profit of 1:1. Or second way is, when you get 1:1, instead of closing the trade, you move your stop loss to the entry point. Wherever you took the trade, I mean, whichever the point you took the trade, you can move your stop loss to the entry point. So that this will become break-even trade. So now what happens? Either you can get more than 1:1, it can go to higher. So in this case, you got 1:2 also. So instead of closing at 1:1, you can exit at 1:2 also. But this trade will become risk-free trade because you moved your stop loss to the break even. So this will become a risk-free trade. But if you use that concept over in this example, let's say in this example, this is the high, first two candles high and low, third candle could not break it, fourth candle could not break it, fifth candle broke it. So fifth candle broke it, here you will enter, here you will keep the stop loss. Now you got 1:1 target hit. Then what happens? The stop loss from here, if you move to the break-even level, then the price came and hit your stop loss in this case. That means even though this is a risk-free trade, you could have booked your profit at 1:1. But since you missed booking the profit at 1:1, it got to the break-even and then risk-free trade got happened. So in this case also, you're not losing money, but you have missed out on 1:1. So it is up to you whether you will book at 1:1, that's up to you, or whether you will move the stop loss to the break even, that's also up to you. There is no single proper exact way to follow that. And then there is no trade opportunity here because you can see the Nifty 1 minute time frame. These are the first 2 minute candle high and low. So there's not a proper breakout candle. And without this, during this candle, there's one more wick that has formed. And fourth candle could not break that wick. Fifth candle also could not break it. So no trading opportunity over here. And here also there's no trade opportunity here because there's a first candle, second candle. So we have to draw a range of first candle and second candle. Third candle could break it, but we will not take the trade because just above that there is a institutional resistance level. So we will not be taking the trade here as well. So that is the logic behind not taking the trades over there. And the second scalping strategy is based upon the institutional zones. And this can happen at any point of time. It need not happen at the beginning of the first 5 minutes. It can happen at any point of time. Here also, it can be applied in Nifty and Bank Nifty plus F&O stocks. This can be applied. And see, this is little tricky. Focus upon this properly. The rule is whenever the 1 minute candle touches either the institutional support or resistance zone for the first time in a day. That means what? If it is touching for the second time, then we don't do it. It has to touch for the first time in a day. So every word is important. It has to touch institutional support or resistance for the first time in a day, and either of the next two candles has to engulf the candle which has touched the zone. So this is the rule. Let me show you how this works. For example, let's look at this. This is all 1 minute time frame and also F1 stock. Now this is the first candle which has touched the zone. Now, whenever you are looking, so here it's a reversal pattern basically, because institutional zones, we assume that the quick reversal can happen. So we are making use of that. So in this case, we are looking for a bearish engulfing candle when the price touches the institutional resistance zone. Because if the price touches institutional resistance zone, if there's a quick reversal, we need to make use of that. So we'll be looking for a bearish engulfing. If price touches the institutional support zone, we'll be looking for a bullish engulfing candle. That means, so if you see, this is the first touching candle. Either of the next two candles has to engulf the candle which has touched the zone. So the next candle has engulfed. Engulf means, so the definition of an engulfing candle is, it is sufficient even if it breaks the body of the previous candle. It need not break the wick of the previous candle. Even if it breaks the body, that's completely fine. You can go ahead and then consider that as an engulfing candle. And since it has formed at an institutional level, this is a bearish engulfing candle. And you can take the trade here, short trade, looking for 1:1. And this is also one more example. So for example, let's say this is a touching candle. And immediately next candle itself is a engulfing candle. And that's a bullish candle. So you will be looking for a long entry opportunity here by keeping the stop loss below the entry candle. And here also you can either book the profit at 1:1, or you can trial your stop loss. That is depending upon your choice that you can do. Now look at this. This is the first candle which has touched the zone. Then this candle, so if you see, this is an engulfing candle. We need to wait for a bearish engulfing candle because you're looking for a reversal. So if you see here, this candle is not a bearish engulfing candle, of course, so we'll not be taking the trade here. But we saw that either of the next two candles has to become a engulfing candle. This is the second candle. Second candle has engulfed the candle which has touched the zone. That means, forget about this wick and all that. The rule is the engulfing candle the bearish engulfing candle has to engulf the candle which has touched the zone. That means we're only focus is upon this candle which has touched the zone. We are not focusing upon this candle or wick or anything. We'll ignore that 50% breakout or that long wick. Actually, anything can be ignored. Only focus upon the rule properly. This is a touching candle. If there's a bearish engulfing candle engulfing this candle, then you will be going ahead and then taking a short trade by keeping the stop loss above the entry candle. So that's how perfectly you need to execute these scalping strategies. Each and every word is important over here. Yeah. So and then Asian Paints. This is also one example where, see this, the price this is a touching candle. But after a few candles, we can see a bearish engulfing candle over here. But we will not be taking the trade here because there is one rule that is mentioned over here, which says that the candle which has touched the zone should not break the zone. So the candle which is touching the zone in this case, so the candle which is breaking the zone, breaking means the candle closing above that particular zone. So that has happened. Once that happens, no matter even if there is an engulfing candle within the next two candles, we will not be taking the trade because that condition got violated. So that is, so all the conditions have to be satisfied properly. There are two more examples in Nifty and Bank Nifty. Touching candle, engulfing candle, take the trade. Touching candle is this one. The next candle could not engulf it, but the second candle has engulfed it. So here also you can look for the reversal trading opportunity. So these are the two scalping strategies. Then we will look at how to replicate the spot chart stop loss to the options chart. Now, wick will not be considered as a crossing. It has to, the proper body has to close. Then only we'll consider this as a crossing. If the wick crosses, but the body is below that level, it will not be. It is completely fine. You can look for the trading strategies over there. But the only condition is the body should not break that particular institutional zone. So coming to the replicating of the stop losses, then, so here you see, first thing what we discussed is you need to look for the at the money options only. Plus you need to select the coming week expiry only, weekly expiry. If you're trading on Thursday, select the coming weekly expiry, coming Thursday expiry, so that you know. Then when you're doing that, replicating the spot stop loss to the options chart will become very easier. So now, for example, let's say you're trading here, and here you got to see the strategy number 10. Strategy number 10 is what? I mean, institutional loans reversal strategy. Now here, let's say you want to enter it on this candle. And first of all, for example, let's say you take a trade, short trade here, and you need to, what you will do, you will be looking at the spot chart, and let's say the spot chart is, for example, let's say the spot chart is 16,500 or 17,500, whatever it is, 17,500 put option, because you are looking for a short entry, it's called as a put option. Immediately you will be entering it. That means you will be taking the trade over there. You will be punching in the order. Then you need to keep the stop loss, right? So how to keep the stop loss? First, keep the stop loss in spot chart. That means here you will be keeping your stop. Before even entering the trade, you need to know where you are keeping the stop loss. So let's say you thought that let's keep the stop loss above the institutional zone level, because this might act as a resistance, and you kept the stop loss here. Then extend this stop loss a little bit. You can even use a horizontal line to keep the stop loss. So extend this and find out above which candle the stop loss is there. For example, let's say above 11 o'clock candle, you thought that there's a stop loss because the stop loss is just above the 11 o'clock candle. Then since it's a put option, you will be opening up the put chart. That is, let's say if this is a put option chart, and let's say if this is your entry candle. And here also what you will do, you will find out what is that 11 o'clock candle, and you will be keeping the stop loss below that 11 o'clock candle. Some 10 points gap you can give, or 15 points gap you can give in Nifty. In Bank Nifty, you can give some 20 points gap and keep the stop loss below that particular 11 o'clock candle. Because put options will be opposite. If the market is coming down, then puts will go upside. But you just have to first keep the stop loss in spot chart and find out at above which candle it is there, and then come to the options chart and find out at that particular candle, at that particular 5 minutes, what is that level. Keep the line few points below that particular candle and find out what is the stop loss. If let's say if it is coming around 73, you'll be punching in the stop loss order around 73. That is when you're following at the money. So that's why when you're following at the money, it will be very easier to keep the stop losses. So like that, if you're seeing, as I mentioned, so if the market is not moving anywhere from here and 2 hours got completed, you took the trade around 11:30, and let's say till 1 o'clock also, if the trade is not hitting either stop loss or target, then you may from 73, some 5 points you can reduce, maybe like 68 you can put, because of the theta decay. That means what happens, even if the market is not coming down, if it's exactly at the range bound, your this put options chart might slightly come down a bit because of the theta decay. That theta decay also will happen when you're holding the trade for more than 2 hours like that. In that cases, to counter that theta decay, you can reduce the stop loss. I mean, you can increase the stop loss a bit. Now it was kept at 73, you can put 5 more points extra. But if you're closing within 3 hours or within 2 hours, then that theta decay will not affect you that much. That is the thing. Yeah, we have 2 more topics. After that, I'll be taking the Q&A. So all the questions you can note down and ask there. Now this is strike selection. As we mentioned, you'll be going for the strike selection at the money. In rare cases, sometimes what happens, you might, let's say if you're having a capital of 1 lakh rupees, and if you're risking 2% of a trade in a single trade, and 2% could come to 2,000 rupees. And then when you're taking a, let's say call option entry you're taking, and that's asking for 2,500 rupees of a stop loss. That means what? If you're taking the trade over here at the money option, at the money call option, it's asking for 2,500. That means if you're taking this, you're risking 2.5% of your capital. That is not suggested. You should not cross 2% of your capital. Then what you can do, only in that particular scenario, maybe you can go for one strike, one leg out of the money. One strike out of the money you can go. That is, only you trade in 100 multiples only. Don't trade in 50 multiples. In Nifty, you will be having 50 multiples. Don't do that. So for example, that means let's say at the money 16,700. Then out of the money for the call option means higher one. That means you can go for 16,800. In 16,800, For the stop loss, it might be lesser because the moment you go out of the money, your cost will be lesser, plus the stop loss will be lesser, like that. So you may go for one leg out of the money so that your stop loss might get down from 2,500 to 2,000. But most of the times, try to stick to at the money only. Only in rare cases where there's a minor difference between your stop loss and between how much amount that you're risking, then you can go for one leg out of the money, but one strike out of the money, that to 100 multiple only. So don't do this all the time. Only if you're having any problem with that small capital range, then only you can go for one leg out of the money. Rest all the time, stick to at the money option only. Then the next one. So on expiry days, we can find out the support and resistance normally using the daily time frame, like how we discussed, like normal price action, support and resistance, we can find out. So in the beginning itself, how to set up the intraday charts, we discussed for 1 hour completely. So if you are there from the beginning, so we discussed for 1 hour in detail as to how to set up the charts for intraday. So using that concepts that we discussed in the first 1 hour, you can use that to find out the support and resistance levels. And then on expiry day, along with that, we will also be using the open interest concept to find out the support and resistance levels. So how to find out is, whenever on expiry day only, that too generally it happens mostly after 11 o'clock like that, you can check the open interest data on expiry day. And you see that whenever, for example, this is the open interest data. So whenever you see the highest open interest data on the put side, that generally indicates that many put sellers are present around that particular level. Put sellers are present means generally, if you know, some details about options, you will know that whenever we are studying the option chain data, we need to look this only from the option seller perspective and not the option buyer perspective, because option sellers will keep more amount, 10 times more or even 20, 30 times more amount margin is required to sell the options than to buy the options. So they will put more money. So when they are putting more money, for example, let's say there are 72 lakh contracts are there on put side around this strike price, 16,500. Now that means 72 lakhs of contracts have been bought by someone, have been sold by someone. So for example, this one contract might cost somebody for buying a put option, it can cost somewhere close to 5,000 rupees. But to sell the same put option, that seller will have to maintaining a margin of almost close to 1 lakh rupees. That means to do the same thing, somebody is buying, somebody is selling. A buyer is required to only have 1 lakh, 5,000 rupees in their capital, but a seller need to maintain 1 lakh rupees to just sell one lot of a option. It can like vary a little bit down and upside, but that is the approximate range that will be there. So that is why the seller's stake will be more in options trading as compared to the option buyer's stake. That is why we need to look, because option chain data is all about how the seller sentiment is shifting. So the general understanding is puts more number of sellers are there at some point of level means put sellers means what? Put sellers doesn't want the market to go down. Put buyers wants the markets to go down. Both buyers and sellers will think oppositely. So here, since we need to look from the put selling perspective, when there is a huge selling that's happening at a particular strike price, put sellers who are there around that particular level don't want the market to cross that particular level. That means when the price comes to this level, it can happen that some kind of a support can be observed, because they don't let the price to break that particular level so easily. That is the one understanding, to know that this level can act as a support level where there's a high put OI, that to only check on the expiry day. This data is as of Friday. So this data will keep changing every minute. So only focus upon Friday and Thursday, that too mostly after 11 o'clock, you can check these levels to find out what are the highest open interest that is there that can act as some support level. At the same time, call side also, when there's a highest open interest, that level can act as a resistance level. Call high open interest will be there on the top side. When the price is going up, there will be a higher call open interest. When the prices is going down, you can check out high put open interest. So high put open interest will be treated as a support level and high call open interest will be treated as a resistance level. Along with the basic price action levels, on expiry day, you can use these levels also as an important support and resistance levels. So that is the thing. This website is from Sensible, but the data you can get from other websites also. This particular option chain data is from the Sensible. And the last concept is when you're trading in index Nifty or Bank Nifty, then it is actually required for you to check both Nifty and Bank Nifty together. Don't trade just based upon the Nifty momentum or Bank Nifty momentum. That is because the rule is, let's say if you are trading in Nifty and when you want to go long, then check the Bank Nifty. Bank Nifty, if it is also in bullish mode or if it's in a neutral mode, then not a problem. You can go and take the long entry over here. But when you want to go long in Nifty, but when you check the Bank Nifty is a bearish mode. That means it is actually taking a resistance and coming down. That means it's a clear bearish mode means then don't take the long entry in Nifty, because if the Bank Nifty is coming down, that can pull down the Nifty as well. So here, when both are completely opposite, then don't try to take the trade. But let's say if something is here, let's say if you're wanting to go short, for example, when you want to go short here, Bank Nifty is neutral. That means it is neither completely bullish nor completely bearish, is neutral. When it is new, when the other indices is neutral, then you can go as per your analysis. But when the other indices is completely opposite, if you are trying to take a short entry, but it's completely taking a support and then making a very big bullish candles, then don't take the trade. That kind of a complete opposite will happen around 5 to 10% of the times. Both Nifty and Bank Nifty will completely move against each other. That could be because sometimes the stocks inside the Nifty might react so much like HDFC or HDFC, say I'm not saying HDFC Bank, HDFC or Reliance or anything that is occupying a major component in Nifty might react. That might not impact Bank Nifty because Bank Nifty is not having those stocks inside it. Sometimes it can happen that only the banking stocks might react very volatile or very in one-sided. That might not have effect on Nifty. So in those cases, both Nifty and Bank Nifty might move in opposite directions. But in rest of the cases, 90% of the time, they both move in tandem to each other. So that is one thing that you need to know when you're trading in indices. All the charts are spot charts only. We have never used this future chart. All the charts that we look is the spot charts only. That's it. And now we'll be taking a Q&A. Now you will be getting the Discord community access, but you need to follow the naming guidelines. So you need to basically, after your name, let's say if your name is Arun, once you join that, you'll be seeing your name on the right side or somewhere you'll be seeing the name. You need to right click on that when you join the Discord community. You'll be getting an option to change the nickname. There's an option to change the nickname. There you need to mention your name /IS5. This indicates that this is a name tag basically. That name tag is very important. If anybody is not having the name tag, they will be removed from the server. That name tag says that these people are from particular batch and they are not some outsiders. So that is very important. That link will be shared on the Telegram group. So you can do that. And if you want to know about the complete mentorship sessions like price action mentorship or option selling, complete 6 days of mentorship, and you can check this out as well. Then coming to the Q&A. So now let me know what are the questions that you have for the entire session based upon. Thank you. Thank you, boss. Yep. First, tell me, how did you find the session? How was the sessions went? I mean, like, although we have only 1 day, we discussed previously it was only 3 days. Now we made it, previously it was 3 hours. Now we made it 4 hours so that we can discuss more examples and all that. Thank you. Okay. Now, if you're having any queries, then you can let me know. Discord community, you can join using a link that is being provided. So that link, once you join, you just have to change your nickname. That link will be there. You just have to download the Discord app and you can download that. Video access will be there after 2 days. So maybe by Tuesday, you'll be getting the videos access. So that I'll link and the steps to follow how to watch the video will be shared in the Telegram. Yeah, you can discuss your queries on the Discord community as well. So you can keep it interacting. You can share your trades, all that, so that other people also will be motivated or interactive. It will be so that you can help others. Others can take help from you as well. So the bonuses that you are having is one is Discord community. The second one is the recorded sessions that you'll be getting within 2 days. The other thing is institutional access that I mentioned that I'll be sharing a Google form. You need to fill the form and by tomorrow end, I'll be giving the institutional zones access. Once I update that, you can check, you can enable that in institutional zones from the invite only scripts. Under the invite only scripts, you'll be finding that. Ebook also will be shared. This PDF, entire PDF will be shared on the Telegram. So you can download that PDF. Is there any single strategy for index trading with the help of indicators? No, why do you want single strategy when we discuss about the 11 strategies? I don't understand the logic behind asking for single strategies. All the 11 strategies are mentioned so that whenever any different types of market conditions, some strategies might work, some strategies will not even get triggered. So you need to learn all the strategies. Depending upon the market conditions, you need to apply whichever is working. It's not PPT, entire thing is PDF only. So I'm saying that this only, whatever that has been shown over here, this PDF, that will be shared. There is no PPT for us, only PDF is there. Zones access, as mentioned, it will be for 90 days. Which one would be good to sustain in the market for long run? Option selling, option buying, need your suggestion. Now that will be a long discussion that can happen, but over the long run, option buying, it requires very high emotional management. That means even if there is a single day where you get frustrated or where you get over traded, you can ruin your entire profits that you got from even for 1 year of profits also might go in a single day. But that might not happen in option selling. Option selling, there's a that very much advantages could be there when you actually do it on a right basis. That like passive income strategies can be very much possible to create over time in option selling. Option buying is can be possible, but you need to be very, very careful in option buying. Now, to change the tag, you need not buy any subscription in Discord. You can just right click on that. You can change your nickname. Change the nickname. Don't change the username or anything. Just click on the right click on your name and you'll get the nickname change option that you can use. Nickname is like after your name, you need to put IS5 that I'll share again on Telegram as well. So IS5 is the tag that you need to do. No, CPR or institutional source or anything you should not be using on either options chart or on futures chart or anything. You need to use only on the spot charts only. So don't use any indicators on any particular options chart or futures chart because spot chart is the main chart. You need to use only on that particular thing. How to improve the psychology? Psychology improvement again takes 4 hours of discussion. That obviously is not a concept on this particular masterclass that we generally cover on ultimate price action session where we'll discuss more than 4 hours on how to get better at trading psychology. Discord link I did not share yet. I'll be sharing once the session is completed on the Telegram. To get institutional zones for more than 90 days, you can ping me on Telegram. I'll let you know the process of that. 1 minute time frame, how to keep stop loss in long side stop loss candle. No, I did not get your question only. You're saying 1 minute time frame and then you're saying week below candle close. What is that week below candle? I did not get your question. Kunal, I did not understand what your question is. Thank you, Gaurav. Any discount for main course? Yeah, there will be 999 discount will be there when you're taking any of our main courses, which is price action course or options course. So since because these concepts what we discussed, this portion also will get covered in price action course as well, in the options course as well. So since you already paid for this particular thing, there is no need for you to pay the same amount for the main course. So this amount, whatever you paid, now will be getting as a discount when you want to take the main course. Ramesh is asking any premium service. Premium service means like nothing specific premium service. If you're taking the options mentorship completely, then obviously around 20 hours of discussion will be there in the option selling and option buying and all that, passive income strategies and all that. Then we'll be having a special access to the option discussion channel. There only the people who are enrolled for the options mentorship, they will be having the access to that particular community where I'll be sharing my weekly option selling trade setups and all that. So that is one of the premium service for the options mentorship sessions. But apart from that, all the Discord, rest of the channels access will be available for you as well, except for that option discussion channel. Rest all the channels you can access it because that's only restricted for options mentorship students. My view on Nifty tomorrow, it looks like already the Nifty is down. I mean, SGX Nifty is already down by some 0.6%. So yeah, definitely. I was expecting from last few days the market correction has to happen, but obviously, if you see the information that I posted on Telegram, the FIIs are buying very heavily. So unless until they stop buying heavily, net buying, if they doesn't stop, then we cannot expect a correction. But I hope that by Monday they might stop the excessive buying so that market can actually correct it. Market cannot continuously go up above 80 MA in 1 hour time frame for this much of a time. It definitely has to make a correction. The option selling adjustments obviously will be covered. So there will be more than multiple adjustments that we'll be discussing for each and every option selling strategy. Anything like completely upon options trading from buying to selling and adjustments and hedging and everything, end to end will be covered in option selling. What is the probability of these strategies? When you follow the properly, more than 60 to 70% would be the probability. It can even increase depending upon if you based upon like more experience when you have, you will definitely identify when are the times which we need to deploy, when we need to not deploy. So many of the traders who end up hitting the stop losses is even though when they know the strategies, they don't know when to stop trading. That means they don't know how to identify a range bound market and when to stay away from that particular market. That is one of the main key thing that if you figure out, then you can end up, then you can avoid many false breakouts or low probability trade setups. NSE website will provide you the FII and DII data. If you're having the sensible subscription, not only you can just search for FII and DII data. There are many websites that are providing those data. NSE website also you can go for it. If you're having the premium of subscription of Sensible, you can go for that as well. There is no gap filled in last few days. So tomorrow the market is down 3 to 5 days. No, because like see, if that's what I'm saying. If it's a normal days, then definitely we can expect a market to come down. It has to actually come down on either Thursday or Friday only. But we can see that whenever the market is trying to come down and continuous buying was happening, that is because of the FIIs. So we don't know when they will stop. So if they stop by Monday, then we can expect a correction, of course. If they are not stopping, if they're still wanting to put in more and more money, then of course that price action might not exactly work out. The price might not come down. It can continuously go upside. Price action course covers right from the basics of price action strategies to the swing trading and positional trading, intraday trading. Intraday trading is whatever we covered here only will be covered. But swing trading, positional trading, and trading psychology, risk management concepts, and all the price action concepts will be covered in ultimate price action. But for options trading, option selling or hedging or adjustments, those things will not be covered in the price action. For those things, we have like 6 more trading sessions are required. That's options course is a completely different course. Yes, definitely you have to test the strategies in the live market. Then you will be getting to know how to even like look at it, because now it is like the entire charts you can see, but in the live market you don't know what's going to happen. So you need to have that conviction to even deploy the trades at the right time. You cannot delay in deploying that particular trades thinking that whether it will work out or not. You need to have that dareness or that risk management you need to proper. If you are doing it, then you should go ahead and then test it out. If you are fearful and then not testing it out, then the results might not happen. Yeah, from the websites, you can get to know about all the other courses. I also gave a link over here at the end of the slide, so you can check that out as well. I think the market might move sideways before the monthly expiry to make up the down move. Yeah, we also don't know exactly at what time the prices, at what time the gaps, if you see on the Nifty, definitely there is a good gap ups in daily time frame that needs to be filled. But whether it will fill in the coming week or not, that we cannot say actually. But it can either slightly make a correction and then continue in the sideways momentum if the FII stops buying. But correction till so these two levels are the main levels of a gap up. So this is one gap that has formed, and this is one more gap that has formed. So when these gaps will get filled might take time, I think, because just now, because they have bought heavily, now itself I don't think they'll sell heavily, because from last 5 days heavy buying was there. I don't think, because heavy buying has been seen in futures open interest. Futures open interest will be having a monthly expiry for this month and for the coming month also. So I don't think immediately they might sell completely, because since they are buying for the monthly expiry, that means what they are assuming, FIs are assuming that if the price goes up, their futures will give you profit. If the price is coming down, their futures buying will give them loss. So obviously it could be a range bound, or slightly this gap filling could be possible. This gap filling could be possible and range bound could be possible. But these gaps, I don't think it get filled very soon. It may take some more time to get filled. That is just my perspective. Of course, anything can happen in the markets. Which thing attract you for the stock market means nothing. Basically, I'm not a socializing person I don't like to be in the midst of multiple people, like in the corporates, etc. That is one thing that used to be where I will just be myself and then I'll work on that. So that is one thing. That could be one thing. And second thing is I can do it even when I'm traveling. That is one more thing. Basically, multiple reasons could be there to like the stock market trading, especially. In CPR, we use only CPR pivots of previous day high and low. Yeah, CPR pivots and then previous day high and low only you will be using. So rest all things you can disable that. Brief things about myself. I'm a qualified chartered accountant. So after that, I did corporate job for a few years, like 1 or 2 years, 2.5 years actually. But before itself, I used to have some knowledge on stock market. That too because we used to have some concepts of futures and derivatives in our studies itself. From that point of time only, there was a little bit understanding that we used to have. But after that, actually, I'm an entrepreneur having other startups as well. So my influential trading is my kind of a startup. But to know that, definitely I need to be in such a position where I can teach the other person as to how the market works and all that. So with my experience, teaching has been started from almost 1.5 years, I think. Before that, I used to do it on my own. But definitely there has been so much of learning that has happened even pre-COVID or during COVID as well, which all the information I thought to bring it into teaching so that the brand also can be built sideways. At the same time, the mentorship and then some brand building. Everything is a combination of effect. I see mindful trading is as a startup which can, like, depending upon how the time unfolds, we can introduce some other services as well. But that's how we look at it. So I see myself as an entrepreneur rather than a trader basically. Thank you. Where do we get the institutional zones? As I already mentioned, you need to fill in the forms, Google form. Then you'll be getting instructions as to how to add the indicator. But tomorrow end, you'll be getting the access. Forex trading, I used to do it, but now a little bit of a time constraint, I'm not doing it. Yeah, that's also actually good. I mean, Forex trading is also a good thing if you follow the right risk management properly. But the thing is that doesn't have an end time. So you need to trade. I mean, markets will be continuously running for all the 5 days in a day. So that might take away your time to keep checking the market. So presently, I'm not doing it. Lokesh, regarding the mentorships, you can ping me on Telegram. I'll discuss over there. I'm from Hyderabad. Fayaz, you can ping me on Telegram regarding the tax saving things on options profit. Generally, since everything is documented, not that much you'll be able to save from that particular thing. Apart from, let's say, if you're registered as a business, then you can claim multiple expenses to reduce the profit from the business because options profit is considered as a business income. So you can reduce on that particular grounds, but you cannot remove anything from the data because you need to directly download the data and everything you need to upload, all the transactions you need to upload. So that's where you cannot do, but some other things like normally, logically, where you can increase the expenses, then the profit might come down. That's there. That's it. Any other things? Anything else? Yeah. Free consultancy we have for everybody actually. So we already posted it on Instagram that consultancy, like we have other tax experts. I don't do it generally. So those people will help you to understand how to file your taxes, and they will be also helping. They'll be charging some minor amount for filing, but you'll get in consultancy. You can ping us on Telegram or Instagram so that I can connect you with our experts of tax. No, presently, we don't have any office in Hyderabad. The traffic is too huge here. Even if we take a space, like just for going and coming, it's more of time rather than just sitting at home and then doing it. Maybe if requirement happens, then we might take it nearby. Otherwise, as of now, it's not. Thank you all. Yes, Ritik. Thank you. We'll be winding up now. It's almost 4.5 hour session. That means we started at 7 o'clock. Now it is 11:30. So 4.5 hours. If you're having any queries in changing the name in Discord, you can ping me on Telegram. I'll help you on that. So entire community, I might not handle. Some support is there. We have 2-3 support staff is there. They'll help me in something else in operations. They'll take care of that. I'll overview everything, but something somewhere where I need to only manage, I'll manage that. That's it, right? So can we wind up the session? Thank you, everyone, and I'll be sharing a link on link on Telegram for the feedback. So try to give your genuine feedback. That will really help us. That's it then. All the very best and good night. For any further questions, you can ping me on Telegram. Thank you. Bye.